Good afternoon. We welcome you all to our today's workshop on free trade agreement with India, Australia and India, UAE. Welcome all the delegates who have come physically and attended the workshop within the chamber premises and the delegates who have joined online. I now request our chairperson, Mr. T.B. Chatterjee, the chairperson of the Indirect Taxes Committee of the Bengal Chamber of Commerce and Industry and partner and mentor, TCN Global and Economic Advisory Services LLP, to deliver the welcome address. Sir will take the session on foreign trade agreement along with another speaker from Deloitte. He will be joining in another 10-15 minutes.
Okay.
Over to you, sir.
Thank you, Sarvani. Good afternoon to all of you. Ladies and gentlemen, I think one lady is there. So thank you very much for coming here. We have got a very good response, but mostly people are joining online. But we tried our best to organize our workshop mostly on a physical format. The advantage of physical format is that you can get a classroom feeling and question answers are more practical, and by seeing the face of a person, at least we can assume that whether he is in a position to understand or not. That is missing in a case of online representations. So we have just started online offline sessions because still we have some corona effect in our mind and body, but slowly we'll go totally on offline systems. The basic intention of organizing this workshop is to basically explain you about these two historical agreements, and also I would like to discuss little background of the FTA, how it is done, how it is related with the whole economy of the country, and to what extent it can help the country to grow. So many of us really do not know the union financial issues of the country, very important things. So I would like to discuss the core issues and which will help you understand the entire subject. Fortunately, we have very good speakers today, and Mr. Nathani is coming. He was instrumental in completing these two agreements physically. He was not only in India, he had gone to UAE, he had gone to Australia along with the ministers, and you will be listening him about the practical aspects of these trade agreements. But before going to the trade agreement, I would like to discuss certain core issues. This knowledge should be there with each and every one, whether he is an indirect tax professional, direct tax professionals, foreign trade professionals, or even an Aam Aadmi people. This is what I am telling you. So what I am going to tell you, that is not a very unique thing. You are supposed to know. But why I am explaining him, just to recapitulate the major issues so that you can understand to what extent the FTA is relevant in our economic systems. So I will just explain you, friends, that any country's economic policies, very important thing, please understand, any country's economic policies or financial policies are governed by invisible hand of economy, which you do not know. But I know what are the various policies which are governing the whole economic systems. Are you getting my point? How the economic systems are governing. Why there will be export? Why there will be an import? What are the factors depends on export and import? Now if I ask you why international trade takes place, today's discussion will be basically in the international trade. Why it takes place? If I ask you why international trade takes, what is the basic reason? Why other countries will buy your product? Or why you will buy other countries' products? It's a very simple reason, all of you know very well. But probably you cannot recapitulate. My job is basically to recapitulate, and then you will be able to link it with the FTA. The international trade takes place only because of one reason, not two reasons or three reasons. Because there is a difference in price. You now think that you export because you are competitive to the other country. That is why people are buying product from you. Similarly, when you import material, you import from China in spite of knowing some adverse positions because of price difference. So by and large, you can say 80 to 90% reasons for international trade, only one reason. I am not talking about crude oil or some other issues, that seen products or something like that. But overall, the international trade takes place only because of price. Now, what I was explaining you, the first answer to my question is, price difference is the core reason for international trade. Is it clear? And if you don't agree, please tell me. This is an interactive session and you must get the benefit of physical interference.
Hello.
Now, what are the basic policies which govern the country? Economic policies. Why I am talking free trade agreement all on a sudden, leaving everything? There are 5 important economic policies govern the whole country. You are under that governance. Your company is under that governance. What are the most important, including a farmer or even a chapati seller, he is also under these 5 governance. But we do not know much about it. First is the economic policy. There are 5 policies which govern the entire economic system of the country. And every policy has a specific purpose. Is it clear? Every policy has a specific purpose. First economic policy is called monetary policy. It is governed by Reserve Bank of India in our country or Central Bank of India under the Ministry of Finance. What is the objective of the monetary policy? The objective of the monetary policy is to control the, you tell me, availability of the liquidity in the whole systems. That means it has the power to increase the liquidity, to reduce the liquidity. This is a very old system. What is the main purpose? The main purpose is basically to contain the inflation. Now, every economic policy has a specific purpose. The sole purpose for monetary policy is to regulate the liquidity in the whole system through their various methods. All of you know that the monetary policy meeting is held. Their interest rate sometimes increased, sometimes reduced. It is basically to control the flow of money in the whole system. Like few days back, Reserve Bank of India has increased the repo rate. What it is impact? Once repo rate increases, what will happen? Bank will start increasing the interest, both to the fixed deposit holder and also to the borrower. When fixed deposit holder gets higher interest rate, what will you do? You will put your money to the bank because it is a secured investments. So money is coming from the systems. Are you getting my point? Then the borrowers, they are concerned because their interest rate has increased, so they will not borrow much money. So naturally, fund is coming down. Are you getting my point? As a whole, what happens? If the money comes down in the whole system, price will come down. Clear? The objective of the monetary policy is basically to contain the inflations. This power is given in the hands of the central government. Every country has this power. Next is the fiscal policy. What is the fiscal policy? It deals with the revenue. You see, it has nothing to do with the monetary policy. It is to deal with the fiscal. Fiscal means mostly on taxations. What is the objective of the fiscal policy? Is to have a optimum revenue in the systems so that we have less amount of fiscal deficit. Fiscal deficit means borrowing from the market. So every country should try to reduce that. So by way of increasing the tax or reducing the tax, they create an environment by which the allocable surplus in the hands of the Aam Aadmi is increased or decreased. What Einstein said about the revenue, this is a very important quotations. It is there in my bad book. That any fiscal policy should be like a bee, BWB. The way they grasp the honey from the flower should be the policy that should be followed in imposing any tax, which means that you charge people, you tax people, but make sure they do not feel pinch. Like the bee grapes the honey from the flower, and flower cannot understand or they do not feel that honey is being extracted. The same way the fiscal policy should be there. But make sure that fiscal policy is sound enough to tackle your expenditure and income. Is it clear? To avoid bankruptcy. And this fiscal theory is being maintained even during Ramayana period. You will be surprised to note, I have seen that, and a question came in my Cost Institute question, that what was the fiscal policy of Lord Ram? I am not joking, and it is there in the Cost Institute's study material. Fortunately, I read it. And when Lord Rama, taken his throne, he first instructed Bharat, please come and make sure that your revenue is equal to expenditure. You cannot spend money more than its revenue. What was the revenue that time? It's the land revenue. Is it clear? So land revenue was there even 5,000 years back. Some people say Ramayana 5,000 BC. Some people say Ramayana is 3,000 years BC. So we do not know it is a 5,000 years old or 7,000 years old, but that was the system being followed here. And a country has to follow this fiscal. These two policies are gone. So it is basically one policy is regulating the liquidity, another policy is strengthening the hands of the government so that it can spend its expenditure in consonance with its income. Clear? Next important point is the foreign trade policy, which is our subject. Next, third important point is the foreign trade policy. I am telling you today, the India's foreign trade policy was not very clear after independence. I have done a very detailed study on foreign trade since from Aurangzeb time, 1696, 1660, 1659 to till date. I have studied myself and I studied in IIT also. India's foreign trade, particularly post-independence, it was not very clear. And to be very frank, এসিটাকে একটু বাড়িয়ে দিন না. And to be very frank, export was considered to be a sin in our country, S-I-N, sin. And the decision was that we'll export only to the extent it is required to support our imports. Is it clear? That was the foreign trade policy. We used to call Red Book. You have not seen that book. But sir can remember this book, Red Book, Import-Export Policy. Today you get two big, thick book. Export was considered to be a avoidable event. Export means exporting resources. But those who know the compositions of the GDP, gross domestic product, which is considered as the economic parameters of all countries, that in that calculations, international trade takes a very big role. Your country's GDP cannot grow substantially until and unless you are strong in foreign trade policies, foreign trade matters. Because exports, which is a very, very important subject, exports, which is a very, very important issue, is a part of the GDP. Higher the exports, higher the GDP. You are manufacturing product in India by utilizing your all resources, raw material, labor, etc., etc., and exporting to the another country. So these resources, this is your income. So it should be considered as a part of our total GDP. Like countries which are doing extremely well in international trade, like China is one of them, you find that they have a, even with this $118 per barrel today, they have a trade surplus. So their export is a very, very important component in their total GDP. So it's a very important thing in international trade. And mind that if exports are there, import will also be there. If you say no, export is added with the GDP and import is subtracted, so I will not do import, it is not possible. Because most of the exports are import linked. What is the highest import of India today? You all know that is the crude oil. If I ask you what is the highest export material of India today? Petroleum. It is also petroleum products. Reliance Jamnagar factory basically imports crude and exporting processed crude. So like diamond, we import. At the same time, we are exporting polished diamond and ornaments to the various countries. So import will be there, export will also be there. But we have to see that we, at the end of the day, we get a trade surplus, which is not there today in our country. Now I will try to give you some statistics which will help you to understand why we need to know free trade agreement. We want to know more about foreign trade policy. India recorded a highest amount of exports in 21-22. You all know. And do you know what is the main reasons for that? The main reasons for higher export, of course there are exports, but it is because of the higher petro prices. Because today our raw crude price is $118 per barrel. So when Reliance will be exporting this material in a process from, they will consider 118. But in the first phase of COVID, what was the rate of crude? 10, 20, 30, 40. Even a situation had come when the explorer were offering some cash prize to the takers because they did not have place to keep or store the material. This was the positions. So I just want to tell you that India recorded 418 billion exports in 21-22, 12 months. This is the final figure. But India's imports was around $610 billion. I am telling you about the merchandise imports and merchandise exports. Whenever in the paper you will find exports, do not take the figure by heart. They basically inform you about the merchandise part. Basically nahi hai, 99%. India recorded 400 billion. But that did not specify what is the country's service exports. Now service export is a very, very important exports. Because there the cost is very less and it gives a huge trade surplus, service surplus. You cannot say trade surplus, service surplus. So $418 billion was our exports, $610 billion our exports. So there is a trade deficit of around $192 billion, about $200 billion. And Sri Lanka and Pakistan is just negotiating for $3 billion for their survival. Are you getting my point? They are just fighting, they are just struggling to get $2 to $3 billion from IMF and other countries. And we had a trade deficit of $192 billion in 21-22. But the saving factor is that service exports. We have done 34% enhancement in service, which is around $250 billion service export. It is not reported normally in paper. Into IT is one of them, you must be knowing that. $250 billion, and there we had also to import services because technology is the import and many other areas, and we had a service import of $145 billion. So we had a service surplus of around 106 billion. So my 192 billion deficit has been supported by the service, and that way our still total trade deficit including goods and services is around $86 billion. Still $86 billion we had a deficit between total exports, and I will send you all the figures to you by email. This is the big concern. And we had a foreign exchange reserve of how much? About 8 months back, September 21, $642 billion. $642 billion. And it has been reduced to how much? 593 billion. So we have lost, or our foreign exchange reserve has reduced by $49 billion in the last 8 or 9 months. In the last 8 and mainly because of the higher crude prices. Number 1, edible oil imports. Number 2, fertilizer imports. These are the 3 major imports. And price rise, of course, because of the logistic issues on account of Russia-Ukraine war. But we have registered an agri exports of $50 billion in the last year. That is a saving factor. Now, why I am telling you? Now, you need to have a proper foreign trade policy which basically regulates import and export, so that you can have a vibrant economic policy in the country. It helps a lot. If you have a $642 billion or $700 billion, you are able to regulate your rupee. Mind that. Today rupee has reached 77, which was around 74, 75. The rupee will continuously depreciate if your foreign currency comes down. How? Because in foreign currency, the invisible hand is controlling your buy and sell. Are you getting my point? Suppose the rupee is depreciated. Who will be the beneficiaries? Exporters. Who will face the problem? Importers. It will have its impact on inflation because import cost will high. As a result, crude price will also be high. Your all procurements will be high, and our imports is more than the exports. So it will have a direct impact on the inflations. You might get some benefit because of the exports realizations, but mind that our export is lower than the imports. So you will always be the loser. But if you have a very strong foreign exchange reserve because of trade surplus and other factors, then you can regulate with the currency price. Normally, central banks will not accept. Normally say, no, we do not interfere. But if you have a huge foreign currency, you can always buy currency or sell currency. Suppose if you find that your rupee is depreciating, so what will you do? The central bank will sell the foreign currency in the market, so availability of foreign currency will be available, price will come down. If you find that your rupee is appreciating, 68 aa gaya hai, so exports will be difficult. So the central bank will try to make sure that rupee depreciates. So for depreciating rupee and appreciating rupee, the sale and purchase of foreign exchange is one of the most important jobs in an invisible way by the central government. But if you do not have any foreign exchange reserve, so what is the Pakistan's rupee versus dollar? You know that it was 118, 119. It has crossed 200. Think about, now they are importing raw materials, medicines, and the exchange rate is $1 is equal to 200 Pakistani rupee. Are you getting my point? So do you understand the need to have a very vibrant foreign exchange reserve? We only want what is our price, what is our investments, personal investment. All these investments will have a zero value if the country defaults. countries default because country has several commitments. Foreign currency loan. Suppose you have taken an ECB, external commercial borrowing. You are a healthy company. You are a healthy company, you have huge balance. But your country does not have foreign exchange. You will fail in making payment of the ECB? Yes or no? That means it does not depend on your health. A country may be self-sufficient almost in every area, agriculturally they are very strong, but country does not have foreign exchange. How they will procure the crude? How they will procure the medicines? How they will procure the technology? Without technology, nothing is possible in this world. Technology is the only capital. So for all this purpose, you need foreign exchange. And not only that, you want a healthy foreign exchange. More you have, that is why you must have seen the Chinese Chinese yuan. It does not appreciate. They have more than $1,500 billion foreign exchange reserve. I think it is more than that. 1,500. And our $1,500 billion. And we have around $583 billion. It is 3 to 4 times. So they are careless. Even if the crude prices, they also import 80% of the crudes. Even if it reaches to 200, they know they will be able to manage. Still they will be able to manage the exchange. Are you getting my point? I thought before you go and enter into the India-Australia or India-UAE agreement, you have to understand the need for the foreign trade policy. So I have referred only 3 policies. One is monetary policy to control the inflations, fiscal policy to control the deficit and fiscal deficit. Third is the foreign trade. It is basically to control or regulate. No, I am not using the word regulate. To control the exports, international trade, so that you maintain a very healthy foreign exchange reserve and FTA, preferential trading. These are all offshoots of the foreign trade policy, which will be discussed. These are all the offshoots. The main policy is to regulate, administer the whole international trade. And fourth and fifth policies are equally important to which will basically influence the economy of the country, as I have been telling you. That is foreign direct investment policy. It gives you it helps you to have a sound foreign exchange reserve. FDI and FPI, there are 2 differences. FDI money is a soft money. It is not going to evaporate or it is not going out tomorrow. So every country will aspire for FDI, because whenever any person invests money, he always goes for a long term. Last year, now you could have asked me, then how this difference was made? Because there is a difference in foreign trade. The difference was made by FDI, which is around $84 billion. India got the highest amount of FDI of $84 billion. And this money is not going to go out from the country. So foreign direct investment policy is very, very important. One of them is the PLI scheme, which government has already come out. PLI, profit linked insurance scheme. This is a very good incentive, particularly in the core industries. The core industries where India has the deficiency. And industrial policy, these are the 5 policies which basically govern the whole economy, but in an invisible manner. You don't see that. Whatever you see today in the assembly or parliament, that you see physically, but there are some policies, there are some context, there are some principles which are governing the whole economy of the country in an invisible manner. And these are the 5 most dominant policies of any country, whether it is Bangladesh or it is Myanmar or it is, but we have to understand that. So friends, these are the most important thing, and you know the why country needs a foreign exchange reserve. I have explained you to give a good support to the rupee, particularly in our country. So rupee appreciates means everybody will start coming. Suppose you are an investor, you invested money at 75 rupees. You have sent $1,000, that time was 75. So 75,000 you have spent. Now when you are taking out the money from the country, say for example, it has become 80. The country has to pay 80, but he is getting only $1,000. The prices of rupee has come down significantly. So every investor would like to see which countries where their local exchange or local currency is stable, where currency is appreciating, more money. They will be able to get their dividend. If the prices come down from 77 to 65, they will get more dollar. Are you getting my point? Or you are not understanding? Suppose the company has declared 1 lakh rupees dividend to a foreign investor. If the exchange rate comes down from 77 to 70, he will get more dollar. Are you getting my point? If the rupee goes to 80, he will get less dollar. So what an investor will desire? If I want to come to a country, you always feel where there is a good market, good number of people are very good, consumption is good. This is one aspect, of course one aspect. But where you find the local currency is continuing. Now anybody will put money in Pakistan, anybody will money in Sri Lanka, wherever they find that. That is why why there is a lot of money going out from India today. Under FPI, they are selling. Why they are selling? Why they are not continuing with the investments? Because they know today is 77 to mil gaya hai. Tomorrow it becomes 80, I will get less dollar. Tomorrow if it is 85, I will get less dollar. So these are the basic things which all of us have to know, instead of knowing only GST excise. So these are the 5 basic policies which are governing the whole economy. I don't want to continue further because our experts have come, and I thought I'll take around 25 to 30 minutes, but I think I have already taken little more. So our Deloitte friend is already there. Friends, we have very good speakers today. Please utilize it. Mr. Harvik Shah, he is the director of Deloitte. He will be speaking directly from Mumbai, and that is a great opportunity. Welcome, Mr. Shah, for your kind presence today through online systems. So you know the most of the areas you have to convert. I have just explained the need for international trade, foreign trade, and how it helps the country. And thereafter we will have a very good keynote speaker, Mr. Suhail Nathani. He has already come from Mumbai, Delhi. He is the managing partner, economic law practice and Indian representative to WTO. And then we have a very good special professor, my professor you can say, Professor Biswajit Nag. He is the Indian Institute of Foreign Trade. You must be knowing that foreign trade matters are researched by only one institution in the whole country, and that is Indian Institute of Foreign Trade. In short, it is IIFT. They are the research arm of the government of India since from the day beginning. Now they have started doing some educational services, but it is a research institute and is a professor from Delhi. So you have very good speakers. Now over to Mr. Shah, and Mr. Mani will also be there in the question answer session.
Chatterjee, thank you very much. This is Mani. So I just was able to join in briefly. I will not be able to unfortunately stay on for long for the reasons that I mentioned to you. But I'm delighted to see such a good participation on this forum. I was planning to speak extensively in respect of free trade agreements and the various technical terms on what they entail, because that I believe is followed by a subsequent discussion in respect of both the India-Australia FTA and the India-UAE FTA. So that is coming up after immediately this session. But since I was not able to make it, and since I'm not able to be on the session for some more time, I've requested a very senior colleague of mine based in Bombay called Hardik Shah. He has a lot of expertise in actually doing the ground level work on issues to do with DGFT and other terms. And he's an expert to a very large extent on foreign trade agreements. So Hardik, over to you if you can just get started.
Thank you, sir. Thank you, everybody. And I would like to thank BCC&I for providing me an opportunity to discuss the important topic of FTA. But before starting the discussion, I would like to thank Mr. Chatterjee for explaining the importance of foreign trade in today's scenario when our neighbors are facing significant situation in such a manner that now they have realized what is the importance of trade surplus. Now, what is the importance of the US dollar or other equivalent currencies holding with them? And in continuation to the foreign trade policy, the government has entered into a number of free trade agreements. That, as Mr. Chatterjee said, it's an offshoot of the foreign trade policy. So here also we will be discussing now what is the offshoot here is the free trade agreements. So the government has entered into a lot of agreements, and we'll be covering most of those in briefly what exactly it entails, what it is, and how to claim such benefits, what are the existing free trade agreements already signed by the country, which is India here, and what are which ones are the ones we are proposing to enter into in a going forward near-term future. So we'll be discussing all these, but before getting into that, let's first understand what is a free trade agreement and how it can be an opportunity both for an importer's perspective as well as an exporter's perspective. So there are various kinds of trade agreements, and that's the reason why we generally tend to come up with terminologies like FTA, PTA, CEPA, etc. So let's understand what all types of trade agreements are there in general. So trade agreement is basically an accord between two or more countries for a specific term of trade, commerce, transit, or investment. They mostly involve mutually beneficial concessions. Now, depending on the terms and concessions agreed by the participating bodies, there are several types of trade agreements that could be possible. And I am sure you are in a position to see this on your screen, legible as well. So the first, which you can on your left hand side, is a free trade agreement. Now, a free trade agreement is an agreement in which two or more countries agree to provide preferential trade terms, tariff concessions to a partner country. Here, a negative list of the products or services is maintained by a negotiating country on which the terms of FTAs are not applicable. Hence, it is more comprehensive than any other agreement. For example, India has negotiated FTA with many countries like Sri Lanka, various trade blocs like ASEAN as well. So FTAs are the largest, is the biggest bloc in terms which provides the maximum amount of benefit from a customs duty perspective as well. The second is preferential trade agreement. In this type of agreement, two or more partners give preferential right of entry to certain products. This is done by reducing duties on agreed number of tariff lines. Here, a positive list is maintained. That is the list on products on which two partners have agreed to provide preferential access and duty reduction. Tariff may even be reduced to zero for some products, even in PTA as well. For example, India has signed a PTA with Afghanistan. Next is comprehensive economic partnership agreement. Now, these are a partnership agreement or cooperation agreements which are more comprehensive than a free trade agreement. Now, CEPA, CECA are looking into a regulatory, will also look into the regulatory aspects of trade and encompasses the agreement covering the regulatory issues as well. So CECA or CEPA is having the widest coverage, wherein negotiation not only with respect to the goods, but also with respect to the services, investments, and other areas of economic partnership will also be discussed. It may even consider negotiation on areas such as trade facilitation, customs cooperation, competition, and IPRs. The similar is the comprehensive economic cooperative agreements as well, where in addition to CEPA, there can be a discussion on the trade tariffs and the quota rates as well. The last and the second last would be the framework agreement and early harvest agreements. Now, framework agreement is primarily defined into the scopes and the provisions of orientation of the potential agreements between the trading partner. It provides for some new areas of discussion and sets the period of future liberations. Now, India has previously signed a framework agreement with ASEAN and Japan. Thereafter, they have converted into a complete FTA and CEPA. And an early harvest agreement is a precursor to an FTA, CEPA, or PTA between the trading partners. For example, earlier at the time when India was an active member of RCEP, Regional Comprehensive Economic Partnership, an early harvest scheme was launched. At this stage, the negotiating countries identify certain products for tariff liberation, depending the conclusion of actual FTA negotiation. An early harvest scheme is thus a step towards enhanced engagement and confidence building. So these are the types of trade agreements. Predominantly, what we will be discussing is only three types, which is FTA, PTA, and CEPA, because these are the agreements which India has entered the maximum. So what is this trade agreement all about and how it is beneficial in general? So to understand this, not only the benefits are restricted from or given to the customs duty perspective, but the idea of entering into the agreement between one or more countries, or between India, let us say, as a country, and a block of countries like Asia, ASEAN or SAFTA, means to promote the trade in goods and services, to promote investment from one country to another country, to facilitate the movement of goods from one country to another country. In some cases, we will also get into a scenario wherein we will agree on investment in terms of services. As you hear from Mr. Chatterjee sometime back, services is giving us the maximum amount of trade surplus, because of which we are getting the amount which we can see it in our foreign currency reserves from the government. So when a country agrees or gets into an FTA or any similar trade agreement, the idea behind the agreement is to facilitate the trade between the two countries. Generally what has been seen is that when you enter into a trade agreement, it can be any trade agreement, FTA, PTA, or CPA. In that circumstances, the trade increases substantially. But in majority of the circumstances, India, up till this point of time, was not the beneficiary of those agreements. Our imports have significantly grew in comparison to our exports. So when we compare before FTA and after FTA, yes, there is a significant improvement. But when we see any particular financial year and then compare between that particular FTA, between import and exports, our imports have significantly risen in comparison to our exports. That's the overall moral story of the present day FTA, and that's the reason why the present Commerce Ministry is running day in and day out to change the tariffs in such a manner that it provides benefit to India as well. So the agreements, what we are talking about, the trade agreements, can be bilateral or can be multilateral. So it can be with one-to-one country and it can be with multiple countries as a block as well. So India, ASEAN, India, SAFTA are multilateral agreements. And the framework to provide this policy is to provide a fair and transparent mechanism. Now, generally what we are talking from a financial perspective is that it provides a significant benefits to merchandise only. Significant benefits which you can quantify immediately, because there will be an immediate customs duty reduction which will be there. It can be immediate elimination or it can be a phased elimination. So usually what happens is that when you enter into a free trade agreement, there will be an exhaustive list of goods which will be issued by both the countries, wherein the import duty, and by the term import duty, I'm referring only to basic customs duty. So the basic customs duty as is levied by any country, be it India or be it any other country in whatever name called in the place of basic customs duty, will either be reduced immediately or there will be a phased elimination or reduction. So there can be 3 or 4 different scenarios. One, there will be an immediate reduction in the basic customs duty to 0 within a reasonable time frame, let us say a year or 2. Second, there will be a longer time frame to go for any base year tariff rate to 0 for greater than 2 years. So that will be a phased elimination. There will be reduction as a category 3. There will be a reduction from the base year tariff to a significant amount, but it will not go down to 0. And there will be certain eliminated goods or those goods where the countries do not want to provide the benefits, and that those goods list will be there in the eliminated list or exclusion list. So there could be 4 types of categories in which the customs duty benefit would be given. And here I'm talking only from a perspective of import duty, because if let us say India is reducing the duty, and let's take an example of Japan for the purpose of this discussion. So India and Japan has entered into an agreement, and if India reduces the customs duty on the procurements from Japan, the supplies from Japan to India would merit a lower customs duty. Similarly, when Indian suppliers will supply the goods to Japan, the basic customs duty equivalent duty in their country would also be reduced, and the effective cost or effective amount of duty would be reduced, so as to say the landed cost of the product will also reduce, and that will facilitate the increase in the trade between the two countries. Because when you are competing in a global scenario, there will be a few countries who will have the PTA or an FTA. There will be a few countries who will still attract the basic customs duty or the tariff rate. And if a country is not having a FTA or a PTA, in that circumstances, the Indian supplier, in my example in Japan, would fetch a lower customs duty, thereby getting an economies of scale, which by virtue of this, I mean there will be a higher supplies which will be done over a period of time. But when the two countries come together and they have agreed to reduce the rate of customs duty, there can be certain mischief which can be played around in such a manner that the goods are routed through that particular country. And to avoid that, there are certain restrictions or catch which is there. And those catch is generally known as rules of origin. Rules of origin. And I'll cover that in detail subsequently as well. But just to give a feeler, generally rules of origin means a situation wherein the rerouting of the goods does not take place in such a manner that the benefit of the FTA is allowed without any substantial investment or without any substantial production undertaken in an FTA country. So the rules of origin would be broken up also into 2 parts. One for wholly obtained goods. The wholly obtained goods are the goods like agricultural produce. It can be wheat, rice, or even fruits or crude oil as well. And the other is manufactured goods. Now, in a case where you are manufacturing the goods, let us say a mobile phone, that is a scenario where you can import a lot of products, a chipset, a screen, or battery, or any other thing from other countries, and there will be a value addition which will be done in your country. So there will be a 2 scenarios. One is for the wholly obtained goods, and the other is for the purpose of manufactured goods. Now, in the case of wholly obtained goods, generally the rule is that those goods should have been manufactured or those goods have been originated in that particular country or the FTA country only. But in the case of manufactured goods, there can be a scenario, like I said, that the raw materials would be imported from other countries. Over there, the conditions which are mentioned is for a bare minimum change in a 4-digit level of tariff classification. So the goods should undergo the imported goods, the raw material, and the finished goods should at least have a change in the tariff classification at a 4-digit level. so as to prove that there has been a process which has undergone in the FTA country. That is one. Two, there will be a value addition condition which will be prescribed. Those value addition conditions are usually around 35% on an average. It depends from agreement to agreement, but from my experience, I understand that it is 35% on an average. And that is also a scenario where, let us say, the defense procurements in the country where we have to do, there will always be a domestic production criteria which is given. And that value addition is similar to that only, that within the country, at least 35% of the value addition should have been done. And there will be different methodologies or different combinations of these strategies which can also be there for the purpose of demonstrating that the substantial transformation has undergone in an FTA country. So what are the benefits which are there for in the trade agreements what we are discussing over here? So first and foremost, like I said, there will be an increased volume of trade between the FTA countries, and wherever India has entered into an FTA or a PTA, the volumes between those two countries have significantly increased. Second, the history will tell you that wherever any country has entered into an FTA, PTA, or any kind of trade agreements, there was no war which has happened between those countries. There was no war which has happened between those countries, so as to have a peaceful environment across, because the more you trade, right, the more you are dependent on that particular country. And the more you are dependent on that particular country, you may not want to indulge into any mischievous behavior with those countries. So it will always be peaceful. So that's the incidental benefit or ancillary benefit. But from a financial standpoint, if you have more FTAs, right, if you have more FTAs, then in that circumstances, there will be an additional investment from outside the country which also you can attract. So let me give you an example. Very recently, Vietnam has entered into an agreement with European Union. Now, India is not in the picture here, but the irony is that India is the most affected here. Vietnam entered into a FTA with European Union as a bloc. Now, Vietnam is excellent or is fantastic in terms of its textile manufacturing capabilities. And because the textile manufacturing capabilities of Vietnam is exorbitantly high or is comparable to India, what has happened is that the supplies which have gone or originated from Vietnam to Europe have fetched a lower customs duty, thereby a reduced landed cost. And that's the reason India is not in a position to compete or is finding it difficult to match the prices of the product with Vietnam. And if you happen to discuss anybody, anybody from a textile industry, you would have come across a scenario where in the last 2 or 3 years, a lot of Indian players are also thinking or have implemented a decision to shift a manufacturing facility to Vietnam for the purpose of European exports. So India is one of the person or a country who is getting affected just because an FTA has been signed by some another country with some another country, right? So that could be a scenario wherein just because some another country entered into an FTA with another bloc, right, we are the direct persons who are getting impacted. So similarly, let us say if India enters into a agreement with UK, which is into discussion presently, in that situation, possibly Vietnam may feel it difficult, and there will be people who would want to come from Vietnam to India as well. So the inverse situation is also possible. I have seen personally the situations in my practical or in my professional life, wherein we have come across a scenario wherein we need to decide between whether should I produce in India or should I directly import from an FTA country where India is having an FTA with possibly a Thailand, Malaysia, Singapore, or any similar country. And we have gone into such a detailed analysis whereby in some circumstances we have concluded that importing from an FTA country would be far more convenient, cheaper, as well as administratively better than manufacturing in the country. So it depends on a case-to-case scenario, but this is not only beneficial for an importer. So it's the most beneficial aspect is for an importer, but certainly as an exporter, if we are exporting it to another country, we will get a far more market for our products. So we should try and explore supplying our products into those countries where we have already entered into a FTA. So we will be fetching a better product, better margins in another newer markets as well. So that's the basic benefit. But from a supply chain point, as I said, manufacturing or import is the most important topic which comes on an average. Even in the case of manufacturing, let us say we have concluded the fact that we want to manufacture it in India, then with the help of the states competing with each other, let us say there is a vibrant Gujarat event which happens in Gujarat, and the similar event which happens in Bengal, the similar event happens in all the states now put together, that the states are practically competing against each other for attracting the investment. So it provides a substantial benefit for the investor as well. It can be Indian company, it can be foreign company as well, to decide where to establish a new product, where to establish their manufacturing facility. Similarly, will I have a advantage in procuring the goods from FTA countries, or should I procure it from another non-FTA countries? Because there are some few products which are only manufactured or best manufactured in Europe. Now, at this point of time, we don't have any FTA with Europe or any trade agreement with Europe. But is there a viable option which is available, let us say, to procure it from Japan or from Malaysia or from Singapore? So these are the things which we'll have to check. And the only important thing is, once we have checked the supplier or the sourcing, it is very important to get into a discussion wherein they will provide us a certificate of origin for the purpose of claiming the benefit, and suitable provisions are supposed to be incorporated in any trade negotiations in the manner. Now, what is the steps in which we can claim this foreign trade benefit? And believe me, you'll have to accept the fact that claiming the free trade agreement benefits is the most simplest thing in this country. Claiming the FTA thing is the most simplest thing in the country. And I have bifurcated this in 5 different steps, and I'll circulate this deck as well for the reference in the future as well. But so the first step is to identify the free trade agreement or the preferential trade agreement, the product where you are dealing with. Why do you want to identify scenarios where there can be one or more agreements with the particular country? So for example, India has signed an agreement with Malaysia bilaterally. At the same point of time, India has signed an agreement with ASEAN multilaterally. So Malaysia is a member of ASEAN as well. So by that logic, we have 2 agreements with Malaysia. One is multilateral, the other is bilateral. So in that circumstances, you will have to identify the FTA which provides the best benefit. So for example, let us say I am manufacturing a mobile phone. Now in that mobile phone, which of the FTA provides the maximum benefit? For doing that, I'll have to get into step 2 to check what is the classification, the tariff classification or HSN of my particular product, and which FTA provides me the best benefit. These all details you can get from the Commerce Ministry's website. So for all the benefits or the agreements with the country India has entered into, right, all the details will be available in the Commerce Ministry's website, including the chart for the tariff reduction over a period of time. So the entire tariff reduction plan gets agreed on day 1 of the agreement, and what will happen in terms of tariff reduction in year 10 from the date of agreement will also be given. So you can chart out your procurement in such a manner which is linked to the tariff reduction as well. Once you have identified that one of the FTA is beneficial, you will have to check whether I am fulfilling all the conditions which are there prescribed in that FTA. Once you are fulfilling all the conditions, and predominant conditions is rule of origin only. So if as an importer, you'll only have to see whether the person who is supplying the goods is manufacturing that particular goods in that particular country or not, whether they are in a position to demonstrate the fact that they have added, let us say, 35% or more in terms of value addition for that particular goods. And if yes, they can procure this particular certificate, which is called a certificate of origin or COO, from the designated authority in their country and email it to you. Once the email is there, the certificate of origin is there, you will hand it over to your CHA, and and you'll have to guide him to say that, boss, you will have to claim this particular benefit. Once the COO is there, once it is attached to your shipping bill, a bill of entry, sorry, in that circumstances, you will get the reduced benefit of tariff as well. So that's the most easiest step which is there. So that's the most easiest benefit in terms of customs duty which I have ever seen in my life. Now India has entered into substantial agreements, which you can see it on your screen, and I'm not going through in detail, but two of the agreements I would like to discuss at this point of time just as a reference is that India has very recently signed an agreement with Australia, which is an economic cooperation and trade agreement, and the other agreement is India UAE, which is a comprehensive economic partnership agreement. Now my fellow speakers will be discussing this, both of these in detail, so I'm not going into this, but the countries with whom we have entered into the FTA or the PTA is listed down on the screen, so you can very well refer those when I'll circulate this particular deck as well. In addition to that, there are a lot of countries where the discussion is there at a very aggressive and at a substantially higher pace. The first is in the agreement with European Union. Now that Vietnam is having an agreement with European Union, there is an urgency for India to also have an agreement with European Union as well. So there is a active discussion which is going on, or active negotiations which are going on with the European Union as well. After Brexit, since UK is a separate bloc, the India-UK free trade agreement is also under negotiation, and there is all likely possibilities that India-UK FTA will be concluded faster than India-EU FTA, because in India-EU FTAs, there are some 3 or 4 products on which that entire negotiation is stuck, like automobiles from their end, pharmaceutical products from our end, even leaker from their end. So because they want a reduced rate on automobiles, leakers, we want reduced rates on our pharmaceutical generic products and everything. So that those are predominantly the reasons why India EU is stalled. Plus there are a lot of agreements which are lined up. Very recently the Prime Minister has shown an interest in getting into an FTA for a BIMSTEC countries, which is Bay of Bengal countries, which includes Bangladesh, Sri Lanka, Thailand, Bhutan, Nepal, and Myanmar. And there will be FTA negotiations which will start from the next BIMSTEC meetings which will undertake. The last happened in Bangladesh, and immediately thereafter, the meetings which will be there either in either of these countries, and the agreements should likely be there over a period of next 5 years. Similarly, India, New Zealand, US, Gulf countries, and various other countries are also there. But I would like to mention one of the agreements which is there in the last line, which is RCEP, Regional Comprehensive Economic Partnership. That's an agreement between ASEAN countries plus Australia, China, Japan, South Korea, and New Zealand. As of now, India is also a member country, but we are just a member country for the purpose of understanding what is going on. We did not agree with the tariff concessions which was offered to us by other countries, and that's the reason we moved out of the RCEP, but we are still an active member. We have not provided any tariff concessions to any of the countries. Simultaneously, they also haven't provided any tariff concession to us, but we are actively going through all the hearings, all the meetings in such a manner that what all is happening in the forums of RCEP, right, we are up to date. We are still a member, but we have not got into an active role in such a manner that we have provided the duty concessions. So the most important aspect of the FTA is rules of origin, because that's the goalkeeper, that's the gatekeeper, or that's the catch in this entire FTA benefit. And like I said, there can be two major scenarios in which the FTA categorizes a product. One is wholly obtained or wholly produced goods. The other is the manufactured goods. So the wholly obtained goods will require 100% production or obtainment from that particular Sorry, I got disconnected, but give me a moment. I'll come back again. I'm sure you are in a position to hear me again.
Yes.
Yeah, so sorry for the disturbance, but as I was saying, the biggest gatekeeper or the goalkeeper for a free trade agreement for claiming the benefit is the value addition condition for the manufactured goods and the change in tariff classification. And there can be separate processes which will be given. Only on acting on those processes the benefit would be given. So that is one. And there could be an instances where the third country invoicing is possible, or there could be an instances where third country invoicing is not possible. Now, what is a third country invoicing? Let us presume the fact that India has entered into a FTA or a PTA with Japan, but there is a bill to ship to transaction which is happening, and the goods from Japan is being billed to Singapore, and thereafter it's being shipped to India. Now, only and only if the third country invoicing terminology or the third country invoicing condition is agreed between India Japan agreement, then only the benefit of the FTA is eligible. So you will have to check whether the third country invoicing or is permissible in a bill to ship to kind of a scenario in an FTA as well. And there will be certain non-qualifying operations as well where the country does not want to provide the benefits of concessions, duty concessions on those particular products. And very recently, since India is losing out on the FTAs in terms of import versus exports, where the imports are significantly higher than our exports, the government has come up with a new regulation called Karotar. The government has come up with a new regulations called Karotar, whereby they would want to check that in all the circumstances where you are importing the particular products by claiming an FTA or a PTA, in that circumstances, ideally the onus of proving all the conditions is on the exporter. Once the exporter proves that conditions, they will get the certificate of origin from their country, from the designated authority. But now with this regulation in the Customs Act, the onus is also on the importer to prove that the foreign exporter has fulfilled all the conditions, whereby we will have to get all their details. We will also have to get the value addition conditions. We will have to understand what is the raw material which they are importing from some another country. We will also have to understand what is the process or the manufacturing process which they have undergone. Right. So effectively, what I'm trying to say is that there has to be a proper due diligence of the vendor from which you are procuring the goods. You will also have to negotiate the clauses with the vendor to provide you all sorts of documentation as and when needed, if not upfront. Because if the officer, the customs officer, believes that the benefit is not eligible to you, in that circumstances they can ask you for all these documentation. I have come across a scenario wherein there was a certificate of origin which was issued by a Singapore authority, wherein for a particular product the value addition was shown as 75%. Now everybody in this world knows there is no significant activities which is undergone in terms of manufacturing in Singapore, and the customs officer had a belief that there is something which is wrong going on over here, because there is no significant manufacturing facilities which are available in Singapore, and almost everything is imported in Singapore other than financial services. So what is the process which is being undertaken in Singapore? And because of that, a show cause notice was issued. The importer had to prove that we are claiming a rightful benefit, but we could not substantiate. due to any reason, and we have to lose out on the FTA benefits. So what I mean to say over here is that a proper due diligence exercise is supposed to be carried on to understand, if not in advance, to at a later date, to prove before the customs authority that all the terms and conditions have been met. So you can go through Karotar at a later date also, because Karotar is a humongous legislation, though it is a small regulation, but it is having a significant impact on the claim of FTA PTA for the purpose of keeping the records only. Now this is a sample certificate of origin. I'm sure it is not legible because it's not legible to me as well, but it's a simple one-pager document which the designated authority would be issuing to the exporter. In India, one of the major agencies who is issuing the certificate of origin is Export Inspection Council. There are a lot of Chamber of Commerces also who have been authorized to issue a certificate of origin. The only advantage is if you want to if you want to procure or get the certificate of origin in advance, you can also do that. If you want to get it, obtain the certificate of origin by let us say in Tatkal scheme also, that is also possible, like in this case of railways as well. And they'll issue you, if you are a new exporter, they'll do a thorough verification of your documentation as well as your physical activities as well. But if you are a recurring exporter, then they will rely on whatever you have said it, and they'll issue you a certificate of origin. So certificate of origin is a very simpler process, because you will have to do everything online. You'll have to upload all the data from the respective agencies, and there are a lot of agencies which have been prescribed, and you can claim that particular certificate of origin online only. And there are a few things which are relevant from FTA perspectives, and there are certain challenges, the reason by which they are not claiming the FTAs. One is lack of awareness. I have done a lot of sessions in Mumbai. I have done a lot of sessions in FTA in Ahmedabad to understand with respect to the fact that why people are not claiming FTA benefits. And what I've realized is the fact that they are not aware with respect to what all benefits are, what the FTA is a kind of benefit which is available and how it is supposed to be claimed. The second and the most important is the HSN is the harmonized system of nomenclature issued by World Customs Organization is a 6-digit nomenclature, and the countries have been given an option to extrapolate to 8, 10, 12 digits depending upon their requirement. So India has adopted for an 8-digit nomenclature. At the same point of time, there are countries like Sri Lanka, there are countries like America who have opted for 10 and 14-digit nomenclature as well. So there can be a situation where the HSN is not aligned, and that's the reason why there could be a situation difficulty in claiming the benefits as well. And if we are not in a position to demonstrate the local value addition content or the documentation, as I've said with respect to Karotar, then also it could be a challenge. Very quickly, I would like to take a few case studies to explain how the benefit is there. And these are real life situations which I have faced in my life, and that I would like to showcase. I would like to explain it to you. So as you can see, from on the left hand side, there is a infographic which is there. On the right hand side, the same thing is being explained. I'll read out this for the benefit of all. So an electric appliance manufacturing company exports products directly from Thailand to India. Normal duty 10%. We are talking only about basic customs duty over here, and the FTA duties is 0%. Now the goods are re-invoiced through the regional headquartered in Singapore. So the dotted line over here in this particular infographic shows the invoice flow, and the line, the clear line shows the goods flow. Now the goods are re-invoiced through their regional headquartered in Singapore. The third country re-invoicing is not in the FTA text and is considered invalid. As I said just some time back, third country re-invoicing is not allowed in India, Thailand. So the Indian customs rejects tariff preferential claims for the purpose of re-invoice goods, just because of the fact that though India is having an agreement with Thailand, but the invoice for the purpose of customs clearance is coming from Singapore, the Indian customs authorities is not accepting the preferential claim because there is a no third party re-invoicing claim which is there, and hence the customer is losing significant free trade agreement benefit on several months while the seller restructures the transaction. Now the manufacturing company switches to direct invoicing so as not to miss on the preferential benefit. Just because there was an invoicing which is routed through Singapore, the 10% customs duty benefit was getting lost. So the lesson over here is to make sure that the commercial arrangements are valid as per the FTA norms. So this is the most simplest of activity which that particular company could have done it, but it was there in their norm to issue the invoices from Singapore, and that was the biggest challenge which we had faced to insist them or to agree with them to issue the invoices directly from Thailand so as to save on the substantial amount of basic customs duty. The next is relatively different scenario, wherein an Indian air conditioner manufacturer imports parts for manufacturing air conditioners from Taiwan of $10 million per annum. Now, the Taiwan supplier procures raw material from Asia Pacific region. The manufactured parts are exported by Taiwan supplier to India. The goods manufactured in Taiwan are not entitled to reduced duty rates in absence of any FTA with Taiwan, and therefore the Indian manufacturer pays basic customs duty of 10% at the time of import. So the potential basic customs duty which we are talking on these imports is $1 million on a scale of $10 million, which is 10%. Now, what we suggested to them is that the Taiwan supplier sets up an export-oriented unit in Thailand. The Taiwan supplier will set up an export-oriented unit in Thailand. The raw material would still continue to be imported from Asia Pacific region, the same sets of the suppliers, but now into Thailand. The goods manufactured in Thailand, and we are talking about the subject goods over here, are exported to India, and the parts of air conditioners manufactured in Thailand are entitled for a preferential rate of 0% in India Thailand FTA. So moving the base from Taiwan to Thailand has resulted into $1 million of annual savings. And this is the simple example wherein if you will see on a global platform how a company can save their customs duty scenarios, then FTAs could be one of the event or one of the scenarios which will provide you the maximum amount of benefit. So that's it. I wanted to have basic discussions on FTA. I would leave the discussion with respect to India, Australia, and India, UAE to the fellow speakers.
Thank you. Thank you, Mr. Saab, for a wonderful presentations on the basics of the free trade agreement. These are very, very important, as I have explained you, as he has also explained very rightly, that the origin concept is very, very important. Otherwise, what would happen? Suppose you have an agreement, free trade agreement with UAE. Today we have that. The UAE person, instead of manufacturing or value adding in UAE, they have imported from another country, which is not a FTA country. They imported it and sent it to India. So when materials are coming from UAE to India, people will feel that these are manufactured in UAE. So they will try to get the FTA benefits. No, you have to have a specific percentage of value additions, and that is very, very important. Otherwise, FTA benefits will be totally misused. A term called GSP. Have you ever heard the GSP? Generalized System of Reference. It is basically accepted by 15 countries. That whenever you are importing, when those countries importing any goods from any other country, you have to comply the GSP provisions. I have personally got the GSP provisions, GSP certificate from the Export Promotion Council in respect of my company's goods exported to basically the European countries. So you have to go specify, there should be a certificate showing how much amount of value additions you have done, and based on that, naturally you have to depend on, for exports you have to depend on imports also, but you have to make sure that the imports are such that it can fulfill the value addition concept as per GSP provisions. If that certificate is not there, when the material will enter USA or any foreign European countries, 15 countries are there including Belarus and others, they will not give you any FTA benefits. So it is on a reciprocal basis. So India, when they will export material to UAE, they have to fulfill the Carota provisions. Similarly, when UAE also exporting the products to India, they have to fulfill the Carota provisions. What is the percentage? It may differ, and these are all decided by a meeting from time to time. And to discuss that and the process, we have no other person excepting Mr. Nathani, who has got, we are all discussing of theoretically, whatever we have learned, whatever we have heard, whatever we have read. But he is the man who was a part of the government of India while negotiating, their mind that these bilateral agreements are decided not by way of email, face to face, and it is totally on a give and take policy. Absolutely give and take policy. You give me these benefits, I will give you this benefit. Nothing, there is nothing else. Sir, over to you. And I don't want to add anything, but please share your experience, and you will be talking mostly on the India-Australia trade agreement, sir. And you share your experience. Thank you very much, sir. I don't want to give any details about Mr. Nathani. He's a...
No, please, sir, don't.
He is a, what I will say...
No.
Highly celebrated person.
No.
He is a Sachin Tendulkar in our areas.
Sir, please, it's already quite humbling following you in this. It's a pleasure to be here. And I always welcome an opportunity to interact with as many people as I can, because trade is something that is here for centuries and it's going to be here for centuries. Added to this opportunity was the chance to come to Calcutta. I was telling Mr. Chatterjee, my mother's from Calcutta, and I spent many summers here with very, very happy memories. So I took the opportunity at the first invitation to come. Yeah. So I'm very grateful to the Bengal Chamber, to all of you for having me here. And I have a PowerPoint presentation, and we will talk about the Australian Free Trade Agreement. But I just want to take you back to why trade. We heard from Mr. Chatterjee, balance of payment, all the economic issues around this, all very, very relevant and all very important to what we are discussing today. But if you see, trade has been around long before all these theories. There was an ancient Silk Route. India was very much a part of that. Maybe the Bengal Chamber did some good things in the early 1800s. The British was here because of trade. The Opium Wars were because of trade. So trade has always been around. It's only of late, probably post World War II, where we started to try and wrap a formal law around it. So the earliest days was the GATT. There was early days of the European community. It was not even the European Union. There was a coal and steel community. So this is the Adam Smith theory, that each, according to his ability, the Lenin theory, to each according to his need. And then, of course, Adam Smith, that countries who are most efficient at making something will continue to make that. And that led to the WTO. So what was the WTO in 1995? The Marrakesh Agreement said that here's all the countries in the world, we will all treat each other as equals, and we will have this concept of MFN, most favored nation. That means we'll treat everybody equally and we will trade with everybody. Very nice, very laudable. But there are realities. The two biggest realities are that all countries are of different sizes. So you can't treat them differently. And two, the other biggest reality which is played out now is that there are geopolitical alignments which you can't get around. So there are many countries who don't play according to the rules they've agreed, which was one of the allegations made by America against China. There are other values like human rights, invasions, aggression. You don't want to trade with those people. So I remember, actually, I didn't remember this. A journalist who spoke to me recently came up to me many years ago. She had met me and she came up to me and she said, you know, I've been looking for you because I was going to a WTO meeting and you told me don't waste time, WTO is done. And I was such a young journalist and I was so keen to go, and you poured water on it and said WTO is not the future because like-minded countries will get together. And she said, you know, now that I'm writing so much on economics, you were right, I wanted to come and meet you. So that is what we are seeing today. So if you see India's own trade agreements, India's trade agreements were opportunistic and done to share political patronage, recognition, which was the old style. So, you know, I was the emperor, I gave you some rights, you gave me some recognition. So India was also in that mode. Our earliest agreements go back to, of course, Nepal. We signed an agreement with Bangladesh in 1975. Why did we sign an agreement with Bangladesh? In 1975, I think it was. Because we wanted to recognize the new government in Bangladesh. So in ancient India, emperors did two things when they asserted their right on a country. They had the coin print published in their name and they offered prayers in their name. And you'll find, if you're a coin collector, the most valuable coins are for those kings who rule the shortest. So, you know, he printed a coin for 2 months, he was out, but, you know, he was the emperor for 2 months. So in that, we started using trade as a tool for recognition. So we had agreements with Bangladesh, we had agreements with Sri Lanka, of course, Afghanistan, but these were all sort of token agreements. They did not do anything for the economy. I remember meeting a minister once because copper was under the India-Sri Lanka Free Trade Agreement. And in order to circumvent duty, people would import copper into Sri Lanka, turn it into wire, and export the wire to India. Now, Mr. Chatterjee spoke about rules of origin. Now, there's a much more sophisticated approach. Change at the 4-digit level, 35% value addition, all that gets checked. However, in those days, it was, you know, certificate of origin koi bhi de diya, and they exported. I remember meeting a minister and he said, Sohail, really don't waste my time. It is so small that even if all of Sri Lanka's exports into India are copper wire, it will not make a difference to our economy. And I said, sir, it's making a difference to my clients. He says, tell your clients in national interest to forget about it because I'm not fighting with the Sri Lankans on these copper wires. You know, it had become that way. It was like India giving away market access. And yes, at that point may have been useful, you know, Tamil Tigers, you wanted to give some recognition to the government. You can't second guess those decisions. But now in the modern era, 3 things have happened. The WTO has collapsed. Okay. You can't get 150 countries to sit and agree in unanimity. India was the first one to assert itself, and everybody has different views about it. But be it as it may, we never signed off on any ministerial declaration. I remember the Secretary General of the WTO coming to Delhi, not this one, the previous one. He had just taken over and he was trying to negotiate a free trade agreement. And it was such a lightweight agreement that, you know, I'm sorry, I have a way of just saying things I feel. So I told him, I said, this is not going to move the needle on trade, but it's going to protect your jobs. That, you know, you have to be relevant. What is the WTO doing? So, you know, it was this customs facilitation and all that. It's not going to move the needle on trade. Be it as it may, he's given up and moved on. But trade is here to stay. So WTO collapsed. 2, India has become a much stronger economy. Nobody talks about this, level playing field, give us a chance, because today Indian steel makers, Indian automakers, whatever, are playing with the best in the world. And three, there is this whole geopolitical reality brought about by China and Trump, where that this trade flow has to change. So everybody went on this China plus one sourcing strategy, and some countries. So when Obama was in power, he was trying to bring about a trade agreement that would be with Asia, but exclude China. Trump came and said, oh, these trade agreements are beating us up, so we don't want to be part of it. China jumped in, America jumped out, and that agreement continues. India tried to do something in ASEAN, Indo-Thailand agreement. We had 84 goods on the early harvest list. I think they've still remained 84. We've just not done anything because Indian industry was in a manner resisting it. Now we are very much part of the supply chain in the world. But if you see, India has about 20% of the world's population. And we are single digits in terms of trade, 2-3%. As Mr. Chatterjee says, our largest imports were crude oil. Because of our policies, largest exports are also crude oil, but large consumption is also crude oil. Our largest exports used to be iron ore, which is no value addition. So you really don't have the jobs. There was an anti-dumping case I did in 1997 on metallurgical coke, and there were a lot of industry from Bengal involved. So what would happen is that India is blessed with a lot of coal, but we have steam coal more than the coking coal. China has a lot of coking coal. So what had happened is that the Indian steel industry was growing. They needed coke, metallurgical coke. So there were some private standalone coke manufacturing companies who had come up, and they were importing coking coal from Australia, and they were competing and selling it here. So 1.5 tons of coking coal is used to make 1 ton of coke. In those days, the price of coking coal was about $80 a ton. And coking coal used to end up costing about 160 after conversion and sale into the market. The Chinese started exporting coking coke at $120. So we went and told the government that, look, we can convert it just as efficiently. Tell them to export the coal to us at that $80 price. But they were not exporting the coal. They were taking the jobs. Basically, they were making you dependent on that economy, making the coking coal there, coke there out of their own coking coal and dumping it in India. Massive fight. Indian steel industry got involved. Rashtriya Ispat Nigam, Durgapur, everybody was in the fight. Eventually, they put anti-dumping duty, but they excluded steel makers from that anti-dumping duty. But it's all about the jobs now. How do you keep the jobs in your economy and have the kind of growth that Mr. Chatterjee speaks of? Because you need employment, right? And once you make, the world has to be your market. Yes, India is blessed to have a large market, but the purchasing power, all these things. So I'll give you an example. We were in Australia with the minister soon after signing the agreement. Pharma, India is the pharma manufacturing hub to the world. That became more apparent during the COVID time, right? Because we had the scale, we had the plants, whatever else we could do. Australia has a healthcare system, which is one of the best in the world, run on the lines of the English National Health Service, where the state pays for everything. So you don't go to an Apollo hospital, you don't go to a government hospital, you just go to the hospital over there, and the state pays for everything, including nursing, medicine. That means they are one of the largest buyers of pharma. Now, how do you get market access into these countries? Typically, large pharma companies protect these markets because they're very high paying. They don't want Indian generics. They're fighting Indian generics all over the world. However, if you see the government's paying the bill for these medicines, they want to bring in generics. So in the India FTA with Australia, they have given us a concession where they will fast track pharmaceutical products. What does that mean? You can't become a pharmacy company overnight. You can't bring vitamin C, crush it and put it into capsules and say, here is vitamin C tablet. You can't do that. You have to be approved. And the approval process in these Western economies, including Australia, I would put, or Japan, is very, very, very strenuous. You have to have very high standards, and they want to be able to come and inspect you. They want to be able to come and what they call no-knock visits, basically raid you. So all this happens. So India has now negotiated in Dubai and Australia, both the FTAs. So the UAE agreement says that if you are approved by 3 countries, I forget, Europe, US, and I think Japan, they will take your drug as approved. In Australia, they will fast track you for approval. Now, these are very lucrative markets. These are profitable exports for India, and these are growth opportunities for India. So, we need to use FTAs to open these doors for us. So the present minister, I'm very pleased to say, is an excellent businessman. He talks about India, he promotes India, and he actually takes Indian industry and says, what is your problem? You tell us, we will solve the problem for you. You only focus on exports. And that is a sea change from the old regime where we said, oh, we want to be nice to this government, so usko free trade agreement do, isko de do. It was not that, business agreements. Now we are entering into a phase of very strong business agreements. So with a small partner, we're negotiating what I believe could become India's most lucrative free trade agreement, which is with Israel. Israel is 6 million people, but Israeli companies have so much of technology that if we enter into the right free trade agreement with them, Indian exports, largest exports after oil are sadly defense. India has been a net importer of defense. Now you talk about make in India, of course, there are lots of rules. You can't sell to a rogue regime. You can't sell to the Taliban or whatever. But there are protocols, the Wassenaar protocol, there are export controls. So we did a recent mandate for the largest software company in India exporting financial software. Why did financial software need clearance from the Defense Ministry? Because financial software has encryption. And that same encryption is used for finance and some of it is used for defense. So it's this dual use technology. So suddenly, you're in a whole new realm. You don't think of these things. What does that mean? You need a system with your free trade country to say that if I export this sensitive product to you, you will not re-export it. So India and Israel in many ways have an aligned defense objective. So if we are able to negotiate these things away right at the beginning, then you create a whole new market opportunity. So against this background, I just wanted to share with you what is happening in global trade. Then we can talk about what happened in Australia. Nope, not changing. No? Okay. All right. There you go. That's the quick overview of what we are doing. Nicely, it came to a word called ECTA. The minister was very happy when he was speaking in Australia. He says, ECTA, togetherness, we must do this. But see what we've done. Goods, services, very important for India. Okay. Then trade remedies, because you want to protect sanitary and phytosanitary, which are standards, technical barriers to trade, rules of origin, pharmaceuticals, always free trade, there will be some dispute, avoidance of double tax, and it is a comprehensive agreement. Let me also share another reality of politics with you. This agreement was done at record speed. We started negotiating in May 2011. 11 years it took to sign this agreement. But the main action happened in the last 1 year or less. Two things: China, COVID. So Australia realized that, look, we have to get on another this thing. China and Australia had fights, so China stopped the imports of certain things from Australia. There was the regrouping of Quad. Anybody knows what the Quad alliance is?
US and
Australia.
So they are now in Tokyo.
Yes.
So
Yes.
they are kind of anti-China basically. So they are formulating policies how they will combat trade with China.
Yes. So this Quad alliance brings people from everywhere because China has become so big. But what, I don't know how many of you read this, but while the Quad meeting was going on in Australia, in Tokyo, the Russians and the Chinese were carrying out air exercises off the coast of Japan in the South China Sea. So that's now the realliance in the world, that suddenly China has got close to Russia, and whatever oil Russia can pump out, China will buy. So there's no loss of market for anybody. It's just that the flows of trade will change. So in terms of quantum of trade in the world, notwithstanding COVID, notwithstanding Ukraine, the volume will go up. It is the flow that will change. So instead of China trading with the US and Russia trading with Europe, they will trade with each other. What could the US do? The US did, the only thing that it could do was put economic sanctions because the dollar is still the global currency, right? So they said, SWIFT, you're out. Every banking system you're out of. We are going to attach your assets everywhere in the world because anybody who wants to use the American system has to sign up and attach your assets. So they did that. If you fast forward this world another 20 to 40 years hence, dollar may not be the currency of trade. Mr. Chatterjee may remember that there used to be in the United Nations what they call special drawing rights, SDR, which was a basket of currencies. And every country had a little play in it. There was a time when the British pound was the trading standard. After World War II, that became irrelevant. So this will change. And when that changes, we live in a very different world. But till then, we should enjoy the world we live in. So this is, I'm not going to read all my slides, but yeah, sure. Stop.
Producer to US. I mean, what makes us, I mean, what is the main push? Why we have given the access of our dairy market to Australia?
What market you see?
Dairy products. The dairy products.
Dairy. No. In fact, dairy is very sensitive.
Yes.
It's kept out.
It is kept out.
It is kept out.
Dairy is not included.
It is, dairy is not included.
Including Indian market access.
Yes, including Indian market access for Australian. So this is a late giveaway. I'll tell you how we've come to it. So eventually on trade, you have to sacrifice certain sectors to gain benefit from certain sectors. Okay. So if they give us access for our software professionals, giving you an example, okay, we will give them access to dairy. Those are the kinds of negotiations that happen. It's like, a real business.
Give and take.
Yes.
Absolutely.
So dairy is Australia's strength in terms of cheese and whatever else. So they want access because India is the largest market for this. India may have a surplus on dairy, it may be a sensitive topic, but eventually you will have to start gradually giving this kind of market access, because Australia's largest exports are food and dairy. They have really no other, they say, I'll show you the basket. You take a look at it. So Australia will not give you the kind of access they give you if you don't give them important markets of yours. Third country invoicing is the rules of origin are very strong. The rules of origin are very strong. So when they talk about dairy, they say the dairy must originate from an animal in your country. So you can't bring American milk and make cheese and send it to us. Or you can't bring American cheese, slice it, dice it, wrap it and send it to us. So they've got a very strong regime on that. The agreement itself, not counting all the letters and all, are 695 pages. And you see the rules of origin chapter, I have it, we can discuss it if we have time. But it's a very comprehensive chapter. I've never seen that level. They want you to keep reports for 5 years. They can retrospectively go after you. They want you to give them access to go and even raid a foreign source if they're not convinced. That will be an extreme measure, but they have those provisions. Okay. This is the Australia-India trade. Okay. Trade deficiency. Mr. Chatterjee spoke about that. Look at our exports, hardly much. Imports are mainly iron ore and coal. Sorry, not iron ore. Coal. And of course, now Mr. Adani is gone to own a mine in Australia.
That has not been approved, no?
No, he's opened it. No, he opened it. Also, another thing that happened was that when we rushed to Australia after this agreement, the challenge was that there's an election coming on. And the election happened, as you know, in Australia, and the government got through. And a new government is come. So all the Prime Minister, the Trade Minister, everybody's out. But luckily, all of them are still committed to the India relationship. So when we went out, we actually met not only the government, but even the opposition. Okay. See, this is the finished products, while India's imports from Australia, raw materials, minerals, and intermediate goods. See the second last bullet. Both countries expect trade in goods to double in 5 years to US dollars 50 billion. But you see the last bullet, and I heard the Commerce Minister say this in every city he went to. He says, I know we are projecting 50 billion, but we want this trade to go 100 billion. So whatever we can do. He was taking so much of personal interest. There was an Australian manufacturer of hearing aid. He mentioned that man on stage. He said, look, you need to make in India because you need to bring the cost down. There's so many people who are hearing impaired, and we want the best technology in the world. And a lot of it, is here. So you need to be, whatever you need, you come and meet me. That kind of trade evangelism. This is the large objectives. Okay. Now look at the trading off here, okay? Australia has offered zero duty access to 100% of its tariff lines from India. Such zero duty access on 96.4% value of Indian exports will be offered immediately. And the balance 3.6% will be brought down to zero by Australia in the next 5 years. Okay. Look at the tariff lines. India exports textiles, apparel, agricultural and fish products, leather, footwear, furniture, sports goods, jewelry, machinery, electrical goods, railway wagons, selected pharmaceutical products and medical devices. Now, I don't know how many of you saw this advertisement in the Delhi airport. There was an advertisement in the Delhi airport that said the entire population of Australia goes through our airport in 1 year. So the population of Australia is 60 million. Of course, in India, we are massive. So when the Australians give you this, they're giving you access to a very small market. How many people in the state of Bengal?
How many people?
Now,
10 crore.
how many million is that?
100 million.
100 million is Bengal. Australia is 60 million. So the market in that sense for India is not such a big market. I remember in 1997 or 8, I had gone to China with Philips because in those days there was an anti-dumping duty on CFL lights. Two things. Philips in China made for the world. They did not have large sales in China. Chinese market was dominated by local CFL manufacturers. If you remember, soon after CFL craze came, a lot of cheap Chinese bulbs used to come in, right? So the other thing over there is at that time when I went there, companies like Philips were incubating LED lighting centers for automobiles and LED lights in China. So they didn't show us that R&D facility, but I asked somebody and he said, look, in 7 years, everybody in the world will buy light by square footage. And all automobiles will move to this type of lighting. So, you know, that cutting edge forward development was also happening in a country like China. So Australia brings you that market. A, it brings you a high value market. Okay, pharma and all will pay top dollar. Second, Australia also is able to, Australia is also able to give you a lot of technology on agriculture and whatever else. So when the last stop was the city of Perth, Western Australia. Yeah. Western Australia is very famous for pears, apples, avocados, basically agricultural produce. And they had a stall there with the local agricultural producers displaying their goods. So one of them said, take an apple. So I took an apple. I forgot about the apple and I came to India. When I come out of customs, my bag is marked X. In Bombay airport, they mark your bag X. That means your bag has to be opened up. So I was there only for 4 days. I'm telling the customs officer, कुछ है ही नहीं. इसलिए आपका बैग पे X है. तुमको देखना है. खोलो, देखो. Nothing. He put it through X-ray. Nothing. Maybe he was looking for some electronics. Maybe he was looking for some alcohol. Nothing. So I get home. I'm like, why was my bag marked X? There was the apple, which you can't bring into India. But I'm saying that, you know, they have, these apples are around the year, they grow very differently. So the agri technology that they can share with us is very, very important. Australia did another thing also. Indian exports of software to Australia were about $1 billion or 100 billion or something. And they were dual taxed. Because of a provision in the Australian law, they were being taxed in Australia and being taxed in India. As part of this agreement, they have rewritten saying that any software exports from India, we will not tax here. The way it was written, that provision, is that if you did offshoring and onshoring, so you had 10 people in Australia, but the code was being written in India, they would tax the entire chain, not only the part in Australia. No, in India, customs. In Bombay, they x-ray the bags before they come up. And then that guy sitting there in a rush marks X. So they open the bag up. You're not supposed to bring agri-food, no? But nobody looks for it. I didn't remember it. The guy upstairs was looking for electronics or something. He's been saying, kuch mil nahi raha hai. I said, kuch hai hi nahi. Turns out it was the apple. Now look at India's commitments. And this is an important thing, okay? India has offered tariff concessions on goods imported from Australia. Okay? Now look at this. 40% of tariff lines will be given immediately. Remember, Australia gave 96.4%. Okay? In these 40%, Australia's exports in terms of value are 85%, which is, of course, minerals and whatever else. Balance India will reduce tariff lines in 3, 5, 7, 10 years. Many sensitive products falling under 29.8% of the tariff lines have been kept under the exclusion category, whereby no concessions will be offered by India. Okay, some of these are milk and other dairy products. So milk powder, all that may be out of it, but cheese and all will be in. However, see, no country sits with you and says, you're giving me 70%, I'm giving you 100% of the line, which is to reinforce the point made by Mr. Chatterjee, that it's a negotiation. So they said, look, the Indian market is so important for us, and we need an alternative to China at all costs. So we are happy. When you sit to negotiate at the WTO, everybody says, I'm giving you this. You say, you also give me this. You know, everybody's on that, this thing, MFN, you know, you give me what I'm giving you. Australians are now negotiating with a different mindset. Their problem is, look, we need a substitute to China. We need a strong India, because, you know, when the fight happens with China, there's going to be no people to send large armies, right? And if you saw the statement Biden made when he was at the Quad meeting, surprised many people. He made a statement that said that if China were to invade Taiwan, US will oppose. That's a very powerful statement to make. And I was talking to a friend of mine who's a very powerful political commentator in the US. Okay. When the cameras are off, I can tell you his name, I don't know. But we were talking, and he said that the biggest fallout of Ukraine could be Taiwan. Because if China and Russia come together, if you see Taiwan, I've been there, it's a small island. It will not be able to put up the kind of resistance that even a Ukraine can put up. It's not contiguous land with the Europeans, you know, who are pushing stuff across the border. You can't do that. If the Chinese isolate Taiwan across the island, it's going to be a very, very tough fight. So these are things that, you know, are changing. Wine is a big, big problem in India. Many states don't allow you to drink wine. The Prime Minister recently made a statement saying that people are asking us to reduce taxes on petroleum while they are reducing taxes on alcohol. I did the WTO case on wines and spirits against India. That was the first WTO case we won. And there was a customs duty put at the border to offset all the state duties. The Europeans were very upset, saying, why are you doing that? Each state charges a different rate, but you're putting the duty at the highest rate. So Government of India withdrew that notification. Then all these alcohol guys have to have bonded warehouse in every state. Even post GST, alcohol is not involved. So everybody has a bonded warehouse in every state. So we were joking in those days that, you know, it is operation successful, but patient is dead, because you're still going to pay all these non-tariff barrier duties. But that is the reality. Now to open out wine, but an important situation here is that they have said that you will bring us wine technology, because India wine revolution was really started by Rajiv Samant at Sula Wines. Yeah, so I know Rajiv, and he came back from Stanford. Stanford has a very nice wine growing area there, Napa Valley. And he is originally from Maharashtra, and he went to Nashik and said, oh, I can grow grapes and develop wine from here. And that's how the wine story started in India. It's an industry that is the last 2 decades, right? Otherwise, Indian whiskey, which is the largest quantum selling whiskey in the world, is actually made out of molasses. It's not made out of grain. So if you see in the World Customs Organization and you see in the free trade agreement, they have given access to Indian wine, but not to Indian whiskey, because the definition of whiskey in all countries other than India is different. Whiskey essentially is made by grain, whereas in India it's made by molasses. So these are the kinds of nuances you will not appreciate unless you're sort of sitting there looking at how these things open out. Now these are tariff rate quotas. This is a new thing we've seen. So when you look at trade remedial measures, there's safeguard, there's anti-dumping, there's countervailing. But these tariff related quotas are what? They say if you hit a particular quantity, we will automatically bring the rate up. So let's say the market for pears in India is 500 million tons. Total market, imports and this thing. They will give duty-free access to Australians. They will tell the Australians, if you hit above 50 million, we'll bring our tariff up automatically. And now these ports have become very, very good at keeping data. In fact, the data, this thing is based in Calcutta, no? Yes, DDFT. Not the not NIC. It's the it'll come to me. I visited them in Calcutta. They collect all the data from the ports. And in those days, it was not computerized. Now, all the ports are computerized. Yes, yes. And they are very, very particular. So many of our clients have their goods that are stopped because they have not defined it down to the last 8 digit. And now it's real time. So government sitting in Ministry of Commerce gets this data immediately, saying that, look, this many tons have come. So this is India's sort of safety valve, because they don't want to affect the farmers, they don't want to affect other countries, because we're still negotiating free trade agreements. One thing I've noticed in Bombay, which I don't know if you've noticed in Calcutta, there used to be a season to get apples. They used to come from Shimla, they used to come from Kashmir. Now you get apples through the year. And they come from Washington. You see the US farmers advertising Indian California almonds, somebody's advertising something else. So that whole market has changed. So India needs to start giving part of that market share to others. So remember now 2 things. One, there is the freight cost, okay, which is a deterrent. So you know, by the time an apple or a pear is shipped, unless you carry it in your own bag like me, unless by the time it's shipped from Australia to India, there's a freight cost. There will be sanitary and phytosanitary measures, which is a non-tariff barrier. And then there is one more barrier, that if you become more than 50 million, we will take the duty up. Australia has agreed to all this while giving India free access, saying 0%, and Australia has not put tariff TRQs. Okay, trade in services. Now this is very interesting. When I started working in trade, India's pet peeve was always give our people visas. You are not giving our software guys visas. It is a problem for us. So we don't want to give you market access. That has now changed too. What has happened? In terms of remote working, you don't need your software engineers there now. 1 or 2 guys can be there, they can spec out and they'll send it overnight to India, it'll be written up and sent back to you. All the big 4 also operate that way now. India has become their back office. What Australia has done is that they are saying, we will actually give you visas. We want guys for software. We want people for healthcare. So if you go to certain countries, so I was recently in Ireland and I was told by an Irish resident that most of the nurses in Ireland come from India. They're from Kerala. They need, because these are aging populations. So they want to give visas. They're giving visas for chef, yoga, work visas. Many people come to me and say, sir, I'm getting a chance to go to England. I'm getting a chance to go to America. Where should I go? I say, you go to Canada or Australia. Because if you want to work in that jurisdiction after you stay, you please go to one of these jurisdictions, because that is the best chance for you. Otherwise, UK, to you never get a visa. America also made it so difficult that if you want to really work, and Australians are welcoming. And India now, our education policy is allowing dual degrees. They are allowing twinning. And that's very, very important. Those are where the contacts really start. What is a lovely thing that they've given is a work and holiday visa arrangement for young professionals. So I think if you're between 28 to 34 years, you can go to Australia for a holiday and you can work. So what they will turn around and say is that we need people to pick pears, pear picking season. So let people come from India, take a holiday and pick pears. They do this with Europe. They've given 1,000 visas as a test visa. America brings people from Mexico, but Australia can't bring. So they're very happy to have Indian students who are there for 4 months. 2 months you go pick pears, and 2 months you have a holiday with the money you've made. But see the people to people contact. These are all important takeaways, because these are the kinds of market access situations we need and they need. They're doing us no favor. They need cheap labor. They need healthcare. They need IT. Yoga and chef abhi theek hai. अच्छा है कितना आ जाएगा yoga and chef category में. Even if you give 10,000 visas a year, it's not going to move the needle. So these are kinds of things that are very important. Of course, we give all the Australian cricketers visas to come here and play in the IPL. Right? Trade and services, financial institutes. Okay? Because this is important, because also anti-money laundering and all are important. If you have financial institution tie-ups, then all this, fudging of funds and all is out of this thing. Also, telecom, that's the backbone. Whatever.
Okay.
Cost of healthcare is so important. Yeah, but the cost of healthcare is so important. And the cost of healthcare is rising everywhere in the world. We knew it now with the COVID, right? The other important thing, which is very critical, if you say, I'm a doctor in India, you can't show up in Australia and say, I'm a doctor. They will not give you parity. This is now we are talking about recognition of professional qualifications. Okay? That's important. They will give it to nurses. If you see, India is the worst at creating these barriers. So when the Ukraine crisis happened, there were a lot of Indian medical students studying in Ukraine and Russia. They came here to India, they have to go through a whole other test with the Indian Medical Council. We do it for lawyers. You can be a lawyer qualified in England, but to come back, you have to do a equivalency test. Luckily, in my time, it was not there, but now that's the norm, because they've created these barriers. You have to have mutual recognition of these qualifications. So if there's a dentist in India who's done a qualification with 10 years of experience, you have to recognize that if you want him to practice in Australia. At that stage of his career, he's not going to come and restart his dentistry studies. And eventually, whatever you do, a tooth is a tooth is a tooth. An Australian tooth is same as an Indian tooth, is same as an African tooth. But that's the reality. So you have to start recognizing these. You can't do it in all sectors, and it also depends on how strong your domestic lobby is. But these are the kinds of things that now India needs to negotiate hard. And if you see Western Europe, where I recently came from, the population is truly aging. I'll just take a side away. When Germany let in all these people from Syria, there was such a hue and cry that, oh, they are spoiling the European Union, allowing these Islamic terrorists and whatever else to come in. But eventually there were 1 million people who came, which is helping an aging German population. That was the call Merkel made. Humanitarian is one, but it is also an economic call. If it was humanitarian alone, many people should have done a lot more. But it was an economic call that we need these people. Now, why do they say when you're immigrating to a certain country that we'll have a point system? If you have this degree, we will give you this. If you have this, we have this. They have to start recognizing professional qualifications. Accountants, nurses, dentists, doctors, lawyers, psychiatrists. Because the cost of training these people again is so big. You've got to say, okay, you have this basic degree. You work 1 year attached to some rural hospital in Australia. After that, you can start your private practice. So these are the kinds of things now that we are looking at. Okay. So interesting thing. What does it say? Professional qualification and experience. See that? Okay. Now, we also have a larger framework that overshadows the smaller framework. I don't know if you all discussed if WTO has this MFN clause, most favored nation, that I will treat everybody equally. How does the concept of a free trade agreement fit in under the WTO? Because clearly we are treating Australia more than most favored. Have you all discussed that concept?
We have discussed anything.
So anybody can reconcile MFN with FTA? So it does what they call, I will treat everybody at par. So if you see, you take Pakistan. Pakistan never formally gave India MFN, but India always gave Pakistan MFN. They didn't have a separate rate for Pakistani products. Now, you're right that it does nothing, but the FTA is doing something. It is giving a special rate to Australia. So tomorrow, can another friendly country like Canada not come to you and say, Mr. India, you're giving Australia 0%. You promised me MFN under the WTO. Why are you not giving me? Sugar come. Why can't he do that? Because by the time the WTO was negotiated, there were many of these free trade agreements already formed, including the EU. And they made a statement at the WTO saying these FTAs are building blocks for free trade. So we will recognize it. See the cleverness of this thing. While the European Union was one trading bloc, each country had a different vote. So they didn't vote as a European Union bloc. They counted 25 votes into this bucket. So I'll give you an example, and I told my English friends this. There was let me give you a different example. India and England were fighting for one seat on the International Court of Justice. There were two candidates. One was Supreme Court retired Judge Dalveer Bhandari, who I know, and another man who I know, who was one Mr. Sir Christopher Greenwood. He He is now the master of a college in Cambridge, and he used to teach me when I was a student there, Christopher Greenwood. When the breakup happened between Britain and Brexit, the support that the British were getting from the EU countries as 25 votes just disappeared. And then India was able to vote Dalveer Bhandari. So they were EU was using this as a very, very powerful tool that, we have 25 or now 30 votes that we were using. So they had started using this. They were using this as a lever rather than helping the institution progress. They could have turned around and said EU one vote, right? But each country had their own vote, but they had agreed to vote en masse. So these are the kinds of things that the WTO remains there. So you will have the anti-dumping, the safeguard, whatever that the WTO gives you. Plus you have a parallel track. And these are what modern FTAs are all about, where you have to have a parallel track. So NAFTA, now called the Canada, US, Mexico Free Trade Agreement, has its own dispute resolution mechanism. Then they have the WTO. So, both will apply. So it's just a sign of a more sophisticated trade remedial forum. Rules of origin. Look at this. Now, previously, and Mr. Chatterjee may confirm, that they would take certificate of origin from local chambers. So Bengal Chamber could give, Indian Merchant Chamber can give, FICCI can give, whatever. Now they have said that certificate of origin, Department of Commerce will give. This is to answer the point you made that, I can bring, they've become very, very strict about it. And if you see this Article 4.25, thank you, it will tell you how stringent it can, how stringent it gets. After this, we can discuss if we have time. I know I'm running about overtime, but these are all important things that this free trade agreement is addressed. Separate annexure on pharmaceuticals, which I told you, fast track approval for patented generic and biosimilar medicines using the comparable overseas regulator pathway and fast track quality assessment inspections of manufacturing facilities. This is what they need to do for the new global pandemic. Today, 90% of the APIs in the world are made in China. You can't have that dependency. Even for microprocessors and all. Yes, because but that's the correct thing there. But it's also about self-reliance. Atmanirbhar. Started in India by Nehru, but
it's a very good scheme.
But every country will want that, right? So today, why not sitting in Bangladesh, you feel that, look, I should also have my medical security. Why am I depending on the largesse of India or anybody else? It's a strategically important thing to me. So if you see now, many countries are giving the same kind of boosts. So the export market may get diminished, or you will agree with certain countries saying, I will make these, you make these, and we will. But they have to be like-minded countries.
The PLA scheme is also basically, according to me, is not only to boost the export, it is basically to reduce the import dependence. India, according 70% of the API is imported from China and other countries. Only 30% in API is the basic drugs from which these generic medicines are manufactured. So these are all imported, except in 3-4 companies, all import API. So it is Mr. Modi's decision or they thinking that it does not depend on China. If they stop exporting that material or the higher price or even that, the country will be in great trouble.
So, you're absolutely right, sir. That is very important. And we are seeing a variation of that playing out in Russia right now, where what did Russia do? They told all of Europe, pay us in rubles. Why did the ruble shoot up? Because there's a great demand for rubles for people to want to pay for Russian oil. The moment Finland announced that they're looking or putting in an application for NATO, they turned around and said, we are not selling you our oil. Luckily, Finland imports 3% of its energy requirements from Russia. The true test of the Ukraine war will happen during winter, where there are countries who are 70-80% dependent, Germany, Hungary, Poland, on on Russian energy exports. So it's all and fine when you're in summer, but come winter and inflation hits the roof, it's going to be a huge problem. And they will shift because the green energy push is really hard. They will shift, but you can't shift overnight. And that does not mean the Chinese market, the Russian market for oil will disappear. It means that China will get a cheap source of oil. Now it depends how India plays that game. Right? So these are all complicated things that will play out. Dispute resolution.
According to the latest statistics, Indian import of crude oil in the last 3 or 4 weeks have doubled as compared to the last year. So they are basically trying to source $70 or $80 barrel, and that is why Indian government is in a position to maintain the price. You see, price is not increasing in case of petrol, diesel. Last, I think, 1 month or 2 months. In spite of the fact that today price is 180 right now in Brent, right? I basically look into this price because of share market and other things, you can understand. So that is a great blessing for India to source that $70 these things.
So when the camera is off, I'll tell you a side story on that. Okay, but now in this dispute settlement process with Australia, we actually have a provision where a member of the panel will be picked by drawing lots. It is actually said that, you give 2 names, I'll give 2 names, you put them into the bowl and we'll pick the name. Can you imagine in a dispute settlement saying that, chalo, we trust so much that we'll drop the names into this thing. So these are now newer evolutions because you're hoping that, because of your geopolitical realities, you will not fight with. Governing law will be the text of the agreement. Rule of origin and all, what will you dispute? It depends. The dispute will be judged under the terms of the agreement. So what they will say, have I denied you market access? No law, that's a matter of fact. So suppose I bring up a new barrier saying all goods. Are you familiar with that press note 2? Which said that any investment coming into India from any country who shares a border with India has to get approval.
Yes.
Who is it directed against?
China, Pakistan.
Pakistan का तो कोई investment आ ही नहीं रहा था. China. So now Nepal, Bangladesh, everybody are caught in this. So they will come up with a regulation like this saying that, pairs coming into India must have been kept in a shelf for not less than 4 months to kill all the germs. Then Australia will come and say, but under the FTA, then the standard will be, have you denied me market access by bringing up this new regulation? It's either going to be a matter of fact or it's going to draw out of this. So they use what they call the sort of common principles of international law in these international tribunals, and that's the way it really works. Okay, rules of origin will be argued, but those are factual. Okay, India has also done this. What we've done is that we have said we will establish a working group on whiskey which is what I was telling you, because they don't recognize Indian whiskey as whiskey, right? And India did one more thing, agreeing to give MFN status to wines imported from Australia. What does this mean? This is another variation of MFN. So India is negotiating a free trade agreement with Europe. Suppose India negotiates a better clause with Europe than they do with Australia. So in Australia, they've now said if each bottle is above $5, they will do this. So suppose with EU, they say $3. Australia doesn't want to negotiate again. They say, whatever you give EU, you give it to me. So India says, whatever I give you, I give them, I will give you. So we have even negotiated in a manner future. These are the sector specific. Now I only have slides. Look at the pharma sector. Look at the exports, already high. Great opportunity because Australia has the need. Minerals. See this? Coal, ores. Textile. India's big edge. Gems, jewelry. Australia must be the raw stones. After this, yes, or at par, leather, okay, services, these are all.
That is not included
Don't. No, mutual recognition of professional services. This is the dual taxation that has been stopped. Okay. So this is the opportunity of being a 50 billion market. And look, Australia is looking for two things. One is the geopolitical realignment, and two, for a market that is as big as China. That's the key thing. Of course, we will not absorb the same amount of meat and all that they were selling to China, but fruits, vegetables and all, we will absorb more, right? These are the big opportunities for India in services. Healthcare. Financial and legal processes, they'll have to integrate. Okay, that's it. So thank you very much. I'm sorry I overtook my time, but we tried to make it more of a conversation rather than
Thank you very much, sir. I think you have got a very detailed background of the one very important thing to understand. I just want to share it with sir also, that FTA is an offshoot of bilateral relations to a great extent. Do you think that there will be any FTA with China? Do you think that any FTA will be with Turkey? But the relations with India is very strained. It basically helps to strengthen the bilateral relations. But trade is one thing, economy is one thing, but bilateral relations is very, very important, so that you are not worried about any external enemy. So whenever you are joining hands with any country in a FTA or any type of agreement, you must be very sure that your relations with that country is very good. Like UAE. UAE is totally different as compared to Saudi, Iran, all those countries, Turkey. They are very independent in their economic policies, principles, mostly Western type. That's why UAE and India has a very good relations. But my point, so bilateral relations is very important. It is precondition that if you have a very good bilateral relations, then only FTA can take place. So this is my This is not written anywhere.
Sir, you're absolutely right, because like I said initially, we started using this with governments we wanted to become friends with or were friendly with, recognizing the change in regime in Bangladesh, recognizing the change in regime in Afghanistan, bringing out the Tamil situation in that is the basis of trade. And what this agreement gets right is that there are people to people contact.
Absolutely.
So when you say students can go there, work there, today, you know, I know that Australian cricketers are doing so much of social work all over India, including in Calcutta.
Including Calcutta.
So, you know, the community ties become that much stronger. And you send your children there to study. Many of them will choose to spend some time over there, if not settle over there. So, in a few decades, the whole relationship changes.
Right. So, Prince, this is what India-Australia trade agreement, and over to Sarbani, Professor Mr. Nag.
Thank you, sir, for your nice deliberations on India, Australia, and the trade agreement. And now we have with us Professor Bishwajit Nag, who has joined online from Indian Institute of Foreign Trade. He will update us on India UAE Free Trade Agreement.
Yeah, thank you very much. Can you hear me?
Yes, sir.
Yes, sir, we can hear you. Will you be sharing any presentation?
Yes.
Okay, we are giving you the co-host right then.
Yeah, can I share now? Yeah. Is it visible?
Yes, sir.
Okay. Okay, thank you very much. And also at the outset, I'd like to thank Bengal Chamber of Commerce, especially Mr. Chatterjee. And after the Suhail's, quite eloquent, discussions, my point will be basically on the sideline, on the margin, because he is having a personal experience during the time of all the negotiations. But I'd like to see it from a kind of an academic point of view. So what I suggest that to the audience is basically to complement what Suhail's actually discussions along with my findings. So these two things are on different FTAs, but many of the things are quite common because this new generation FTA are being done quite fast. So you need to have some common thread, and that the government of India is trying to make. Okay, so my job is about India UAE, and just now you have heard Mr. Chatterjee has mentioned that first the basic condition is that the two countries need to have a friendly relation, and there should be kind of a historical and kind of a dependence or understanding among themselves. And all we know that with UAE, India is having a long-standing relation. So just to start with, these are some of the very basic things what I found. One of the most important thing is this government is trying to portray that it has been concluded in 88 days. So the biggest change from the previous generation, FTA is that speed, because we need to harness the opportunities as it is, coming up, as well as also looking at the changing geopolitical situation. We think that we have a lot of opportunities are at our doorstep, so we must catch them. So rather than going for a long kind of a negotiating time frame, if we can get some kind of an early harvest kind of thing. So so UAE and India are quite close trade partner. The UAE is India's third largest trade partner, and our bilateral trade is around 59 billion, which includes both exports and imports. And our target is basically in next 5 years to reach it to $100 billion. So you can understand it's a quite a long jump. Okay. India ranks as the UAE's #1 trading partner among all non-oil exporting countries, accounting nearly 14% of UAE's total non-oil exports globally. This is a comprehensive agreement. Okay, so we need to understand the difference between a free trade agreement and a comprehensive agreement. Free trade agreement mostly talk about trading goods and trading services, which include the protocols by which the goods and service can receive a preferential treatment. So that requires some kind of a framework, which includes rules of origin, which includes some kind of a standards based on TBT and SPAs. You require some kind of a dispute settlement procedure. But when we talk about CEPA, or Comprehensive Economic Partnership Agreement, then actually we take into account many other things. For example, intellectual property related issues, some collaborations among the customs procedures, maybe in some cases, even the standard development. I mean, Shwel mentioned about India, Israel. So I worked significantly in the past, India, Israel. So in that case, actually, one of the major issues that whether together we can work on improve India standards. As you know, for Israel, kosher is one of the most important concept. All the goods need to cross the kosher concept. So so Israel wanted to have a kosher testing centers in India. So similarly, even when we talked about or we studied about India, Japan, especially for exporting processed food from India, Japan was interested to develop or improve the standards in India. So those are basically part of comprehensive agreement. Those are not part of standard free trade agreement. So the first important thing here, that trade is also leading to a development and development for future trade. And in case of UAE, there are other areas, for example, digital trade and government procurement. And you must have noted that in Australia, agreement also pharmaceutical product got a special position, and the same thing for India. UAE is already a big market for Indian pharmaceutical products. And digital trade is an important thing because there is a possibility of a lot of e-commerce, B2B trade. So you require a kind of a legal framework, data protections to reduce financial frauds. So that's why the digital trade agreement is very, very important. So what I'll do, I will first go through the data just to understand from a very naive point of view, that why should we do a kind of a FTA or CEPA with UAE? What kind of challenges we are going to face? Because when agreement is signed, there are a lot of excitement and a lot of expectations, but most of the time what happens on the way, many of the FTAs face serious challenges. For example, India-Singapore Free Trade Agreement, fast agreement had trading services are included. And the movement of natural persons actually faced a huge problem because Singapore government brought up certain conditions by which the visa for the Indian employees were facing are facing some kind of a new kind of barriers, which were not understood as per the wordings of the India-Singapore FTA. I think maybe some of your relatives might have faced the similar challenges during the COVID time. That when Indian employee left Singapore, returning back to Singapore was actually becoming a challenge. Okay, so all the times actually when the FTAs are written, the text are written from a legal point of view, or from some kind of a economic analysis are being done, it is always being done with a high hope that everything what is written in that document will be followed in toto, as well as what will happen that on the way all the challenges can be managed. But it never happened. Like, I can give you an example. For example, Swell mentioned about rules of origin will be now being monitored by Ministry of Commerce. Earlier, the individual chambers were actually are giving the rules of origin, certificate of origin, but we found that there is a possibility of fraudulent activities in that when things are coming from other countries, because the similar practices are there in other countries. But at that time, the wisdom was that it would help the local businessman to get the certificate of origin easily. Okay, I've got one PhD under my supervision. It was the similar thing came up when the study was looking into the complications of the certificate of origin, and then again and again it was coming up. Simplification of certificate of origin is very important. So even if your tariff goes down, there could be non-tariff barriers which would be coming up from a different angles. Sometimes it is unheard of. Okay, so we need to see every FTA definitely with a lot of excitement is there, but we also need to see it from a critical angle, so that you can get a balanced view, and we are prepared that if something comes up, how we are going to manage it. So first we'll do a bit of data analysis, and then actually we move to more critical discussions about the agreement itself. So here is two diagrams. On the left-hand side is India's trade with the UAE, and on the right-hand side, UAE's trade with the world. Okay, so don't look at the left-hand side. Look at the UAE as a market, that how it was doing. I mean, in last few years, and you can see that its import, it's mostly the goods, not services, are slowly coming down, which is the blue line, which was in 2014, it was around $298 billion. And it is coming down to, say, last 2 years, I do not consider as a normal year. So you can see there's a secular but slow decline. In 2019, it was 267.94. So it was going up. And its exports, if you look at, also more or less stable. So it's a market which itself is possibly a matured one, but it is not showing in last 5-6 years a lot of exciting growth. It's not like Australia, for which the challenge was basically China versus somebody else. Okay, so with this country, India is having a very stable and long-standing relation that you need to understand. Large number of Indians are working there. Now come to the left-hand side. If you look at the left-hand side, India's import, which is basically in green color, and India's exports was in blue color. And you can see that India is having a surplus in the goods. This is basically the goods, but not services again. So if you look at the trade surplus, we started coming down because our imports started going up, which is mostly because of two things. One is crude petroleum, and then gems and jewelry. And India's export itself, again, was not showing a kind of a rising trend. Okay, again, don't look at 2021 because those 2 years are abnormal years. So, there could be two arguments, which could be counter arguments. The one argument is that because there are barriers, because there is no FTAs, that's why our exports are not rising. Okay, and that's why what is happening, that we need to go for an FTA. So that's an argument in favor of a trade agreement, that if we get a better market access, then maybe we can change the trajectory. Maybe we can have a rising growth. Okay. On the other hand, the critics might say that this is a declining market. Okay, the declining market, which can be seen from its global engagement, which is on the right hand side. So first, we need to see this entire agreement from this particular perspective, that how UAE as a market is changing. It's not saying anything beyond this, because there could be several product specific significant opportunities. We must harness that. So in some cases, that's why we need to be very careful about that, what kind of preferences we are getting, whether we are getting preferences in the right kind of products, or whether in the name of preferences we are opening the market. And as you know, in UAE is basically a country of transshipments, so many of the products might come via UAE. So whether we have the proper rules of origin, so that we can actually restrict the third country products coming to it. So let's come to the top 10 products what India is importing from UAE. Because there's not much of scope, so I cannot go beyond the top 10, but I have taken the top 10 products at HS 4-digit. So the situation may be different when you look at the 6-digit, but you can get an overall idea that our trade is extremely concentrated. Okay, so I've taken an average share for 2017, 18, and 19, and if you look at the kind of products that petroleum oils and oils obtained from bituminous minerals, which is basically the crude oil 2709, it itself is close to 31.5% of our import. And then if you look at diamonds, whether not worked or but mounted, so it's basically both the diamonds and gold 7102 and 7108. They constitute a significant portion. But if you look at that 7127, these two chapters actually occupy a significant share in our import from that. So what we were expecting, or rather when I started working on the data, I was expecting that because there are refineries, so there could be a kind of a petrochemical product. So we might be getting a lot of petrochemical products, but as you can see, 3901 polymers, their share is just 1.75%. So so India is not importing that much of petrochemical products from UAE, but some of the metal products like copper wire and ferrous waste are important product which is coming in. Now, the earlier one, the slide was actually showing us the share, that what kind of products actually we are importing. But now we can give a kind of an absolute number that how actually it has changed. The data is a dollar million. And if you look at, of course, we have seen it in the last slide that petroleum product actually, or rather crude petroleum having the higher share. But if you look at the other product, which was having a rising share, so it is basically, if you look at diamonds, gold, gas, and petroleum oil, all were showing some kind of a rising trend. Now, these are the earlier one was with the product with higher share. So if you can see it on the left-hand side on the y-axis that it is in billions. But on the smaller products, sometimes the smaller products are very important because they just try to find out a hole to enter into the country and then suddenly become a big import. And exactly the same thing happened with many of the past FTAs, that we just looked into the data and we did the analysis, and I have done many analysis and provided government the support. And many times what happens that the existing imports are very low, but when you, and that's why, because it is a give and take. So when we try to get a big advantage in other sector, then we need to give offer in some other sector as well. So we provide certain some kind of preferences, and then what happens in 5 years time, we find that those areas actually importing significantly. So So that's very important thing. So what I feel looking at this particular uh, slide, or rather the graph, that two sectors, one is copper wire, because India is having a very strong copper sector. I myself have worked with the copper companies as well as copper alliances. So I think that the copper import, which has started coming down 2018, 19, 20, and it is not increasing, because we might be creating some kind of an indirect barrier, maybe in terms of standards, but we need to be very careful about this particular thing. Scrap, ferrous waste and scrap, which is the yellow color, orange color. So you can see that ferrous waste is a very serious issue, because sometimes along with the waste, a lot of contaminated things come in. So, and in the past it happened that, a ship full of, waste came, and then we found out they were contaminated. So we need to be a bit careful about this particular aspect. Light phases, this could be just at one time, so that's not a big issue. Now that's basically when we are opening our window, what type of fresh air we get. Now, let's see that what kind of an advantage we might get. So whether our exports are very well diversified? No. So if you look at here in this particular, this is in the value terms, it is the same story. It's instead of crude, now in the export, we have refined, because India has excess refinery. So India refines and exports it back. So almost 18.53%, and is a very big market. UAE is a very big market of jewelry. So 24.38% on an average. That's our export. And I think it was in the news item, as soon as the agreement was signed, the first product which took the advantage of new FTA was basically a kind of a jewelry company from India, right? So apart from that, if you look at rice, 1006, rice is a commodity, and Middle East is a very big market for Indian rice, but rice is a commodity, its price is very low. Because of a low value product, actually, our share actually goes down significantly. Now, interestingly, among the 10 products, we do not have many machinery products, apart from 8517, which is basically some telephone sets. Also we get huge competitions from other developing countries in apparel and textile exports. So as we move forward, we'll try to understand that, what kind of advantage we can get out of these products. We saw that our exports were not rising, and this is the scenario what we get. Even 2018 onwards, actually, we find that, some declines is like our exports of petroleum, and jewelry is the sector which is, showing us a good fortune. But other products like diamonds, if you look at, it's going down, and telephone sets were showing some rise, but as you can see on the x-axis, that they are of relatively low value. And for low value products, as you can see, they are basically clustered at a very low value, most of the products. And since 2018, it was not doing very well. So having these evidences in front of you, so there could be an argument, which may be in the ministry, that, or maybe with the industry as well, that to push, because this is a stable market for Indian products. So if we're able to push a bit, if we sign an FTA, then possibly we can change the directions of our exports. But what I did, I tried to calculate from the ITC map, the trade potential. Remember, existing trade was around 59 billion, and our target is to reach 100 billion. Okay. So the total trade. Okay. So now what is happening as far as the ITC's trade potential map, I'll show you in detail. We are having an untapped potentials of 12 billion, right? So 60 billion plus 12 billion, so 72 billion. I remember this calculation is done without having the effect of CEPA. So we have not done the simulation with the reduction of duties and preferential market access. So with the preferential market access, this 12 billion will go up. Okay, how much will go up? That requires a longer discussion. I actually didn't get that much of the time to do a bigger simulation. That from 12 billion, how much it will get, but definitely it will go up. So this is a screenshot from ITC trade map. And if you look at the legend on the right hand side, the first three, so that will help you how we need to read it. So the solid vertical bar is the export potential. The round shape is the actual exports. So the distance is basically the potentiality. Okay, so if you look at jewelry, there is a huge potentiality. So you can see is that currently we have around 5 billion. So out of the 12 billion export, the possible rise is up to 8 billion, and with more kind of a reduction or more market preferences, so it might go up maybe whatever it is, maybe 10 billion and maybe more than that. And diamonds also, worked out diamonds also having a significant market. Telephone sets, because I was looking at the machinery products. Okay, remember, you need to understand that UAE is having a very close relationship with China as well. Okay, those who have traveled to those countries, you must have seen that the Chinese machineries are available and seen all over the country. So if you look at, in case of telephone sets, it is already over-representing. That's why it is ... Okay. So the existing one is around 1.5 billion, but actually the potential is much lower than that. So we are having an over potential. But apart from that, rice, we have a small possibility of extension, motor vehicles, and pharma. Pharma it's also having some kind of a large potentiality. Of course, compared to jewelry and diamond, it is nothing. But apart from that, all other products, as you can see, their possible increase without the FTA are not much. Okay, so that's why we require some kind of an understanding, say that how much is the tariff reduction is happening and how much is the non-tariff barriers are being eased out, so that we get a really clear market access. Because many times what happens on the ground, we can see the tariffs go down. We have a lot of expectation, and maybe on the way we see a new kind of a new tariff barrier comes up. Okay, and then what happened? All the advantages or potential advantages in tariff barriers actually goes out. So these are some of the products, some other products as well. So 60 billion along with 12 billion, so 72 billion. But our import will rise expectedly at 5.3 billion. So 72 and 5, which is basically 77. Okay, or maybe you can think of close to 80. So we have clearly a target of increasing our trade, bilateral trade of 20 billion additionally, because this potentiality is anyways there, for which government does not need to do it. It's basically the private sector, the business, a little bit of ease of doing business and more discussions, or maybe a kind of a more contacts might help us to achieve these two targets, 12 billion and 5.3, which is 17.3 billion dollar. But beyond that, there's a gap of 20 billion dollar. Okay, because our target was to reach 100 billion dollar. So we require to understand that whether the existing FTA will help us to push it to this around $20 billion also. Okay. So there is one question which I have received: how it is possible to import petroleum and jewelry from UAE and export same to UAE with higher side? Yeah, we import crude and we import uncut diamond, and we process the diamond here. We put it on the jewelry. So of course the value goes up significantly. Similarly for oil, we import crude and export refined. So the value addition is being done there. So this is a very classic case that the country is not having comparative advantage in the resources. If you look at it, both the cases, the resources are not available in India, but we have a derived advantage because of our past investment and because of our skill by our craftsmen, and that's why we have added another set of value. And these values are much higher than the production cost of the crude oil. So of course, that's as a result of that, we get a huge amount of advantage. Okay, so let's move. So what we are going to get now, you can see that from the other side, from the import side, you can see that the bars have become very long. Our input from UAE are smaller. Of course, it has a small capacity and India is very big. But if you look at that, there will be a lot of craftsmen which will be setting up. I have seen the same thing in Africa, actually. A lot of African countries are now inviting Indian investment in their jewelry sector. So, so diamonds and precious stones are coming to India, but many of them are not coming. They are still stationed. They are rather Indian craftsmen, Indian businessmen now going out there and doing, creating the skill out there. So that could be one kind of a thing. But if you look at the other products, for many cases, these are electronic products, these are scraps, these are, metal products and copper wire. As you can see, that there is a possibility of large increase. So these are the areas actually we need to be a bit cautious looking at the data and what kind of protection we can give it to our domestic players, because in all these cases we have a vibrant domestic sector, and also India wants to improve its capability in electronic sector. So data processing machines are one of the first level of electronic products. And then you can see parts and accessories and motor vehicles which are coming in. So we need to be a bit careful. I also need to check the data, how actually the UAE as a country is developing these motor vehicles parts, of whether they are basically part of investment coming from China or coming from Japan. Because what happens, Dubai being the transshipment centers, what happens many times, as you know, in Jebel Ali port, there's a free zone. So you can set up your factory, small shops where actually you can change the product and can export it. So whether they are getting recorded as an export of Dubai or how actually we need to check it. So this is basically one area we need to be doubly careful about this thing. And so you must have seen these two set of diagrams that our exports potentiality are still very concentrated in only those products in which we are having advantage. Okay, so we are not able to having a new diversification. Okay, so that's the most important. What we are expecting, that when there is a kind of a free trade agreement, then there is a possibility of product diversification. So I'm exporting product A. So along with product A, tomorrow I am able to export A plus. Okay, so more the country is able to develop that particular capability, the country's complexity actually goes up. That's the new literature which Harvard and MIT actually studying right now. What is called product and country complexity. So with the help of this new kind of which is coming out due to FTAs, whether the country is able to do diversification, because you are suddenly getting exposed to a new challenges as well as new advantages, because it's quite possible that from UAE, some investment is coming to India and it is going back again to UAE. So there is possibility of a reverse. So product diversification is a natural expectation from a kind of a trade agreement. So what we are noticing, if we go back, if you see that our exports are still very concentrated in the same products in which we are having advantage, but UAE's advantage, as you can see, it is changing. So UAE is finding a larger market in India and able to diversify the product. Okay, so this calculation is done by ITC export potentials. I am not able to explain you the mathematics behind it, but I can tell you a little bit of that, which is basically looking at the supply capacity, looking at the possible demand, and looking at how different kinds of trade barrier actually moves. Okay, so there are three set of factors which come together and they try to do the calculations. These calculations you may accept or may reject. Okay, so there could be a kind of a debate on it, but I'm not going into that. What I'm trying to say that UAE is able to diversify more because India is having a large market. On the other hand, India doesn't have kind of an intention to export different kind of product because UAE is much smaller market. So when you are having an FTA with a smaller market, then there is no need for diversifying the product too much, because it's the same product. If you do a kind of a more intensive trade, because tariff reductions can lead to a more intensive trade. So in the same product you can carry on. Suppose you are exporting ladies' jacket, so you will keep on exporting ladies' jacket. Okay, you do not need to go into the gents' jacket because that diversification may not have an advantage of it. Okay, so this is the kind of a argument which are very much there. But if you have a larger market, then actually the producers can start doing a trade-off between the men's jacket and the ladies' jacket and just look into that, where actually the more value is coming in. Just in this context, I can refer one thing, which is not related to FTA. That India is one of the major exporters of the leather products, and I reviewed the government of India's leather schemes just before the pandemic. Okay, and then I found, in fact, I had a long stay in Kolkata also and looked into the wonderful Bantala complex and talked to many people there. Right, but what I found, which is quite striking, that India was exporting male shoes, right? But India was not exporting female shoes and baby shoes, because those are non-standard, are very dynamic in terms of style, and not an assured market. But remember, selling one female shoe, could be an equivalent to selling 10 male shoes at the price of international market, which is at the cost level. But that risk, nobody was taking it. So my question is that India may be having many FTAs coming up, whether our producers are really ready to take that risk and diversify the products. So existing knowledge of trade data shows that Indian exporters are generally risk averse. So what is happening? India is mostly, leave with a non-branded commodity kind of products, India is not able to create the brand in the international market. And I can just, with confidence, I can talk about the leather sector because I worked on it. So the similar thing is happening, that if you kind of looking at the product, so these are the kind of thing, except the jewelry, there could be some brand which India has already mentioned. And in case of rice, which is one of the major export from India, is not having a large value. So you have seen in terms of the share. So other products also you can see most of the cases is a long horizontal line. So there is, after FTA, there could be this long line would be higher. So what is my apprehension? Go back to my simple numbers, that we are currently having 60 billion trade, and the ITC trade map says 12 billion is a normal potentiality we can harness. So 60 plus 12, 72 plus 5.3, maybe you can think of 6, or maybe you can think of a little bit more, so 80. Now rest of the 20 billion, looking at this particular thing and having my own experience with the trade data and in many countries and how actually it works, I have a feeling that our import growth will be faster than our export growth, because that market.
Exactly.
Okay, so instead of 5.3, you might be having this 5.3 might go up to 10, 15, and that 12 might go up to 20. Okay, so of course, when it's a 12, so growth will be, even if it is a smaller growth, you'll get a bigger market. So we can get a large penetration of the UAE products in the country. And whenever you sign an FTA, there is an excitement. Coming back home, you also need to work out how you are protecting your SMEs, because in such cases, what is happening, the SMEs face the major challenges, not the big companies, okay? Because big companies can handle such shock very easily. Now, let's do the exercise slightly in a different way. The kind of products UAE is importing from the world, and the kind of products UAE is importing from India, whether these two are matching, the kind of products that means the nature of market in UAE and the nature of product they are importing from India, whether we can expect some changes after the FTA. So these are the main products. As you can see, 72 actually plays a very important role. So iron and steel product plays a very important role in UAE's market, because huge constructions going on, as we've seen many times, you know, whether it is in Abu Dhabi, Sharjah, or in Dubai or outskirts, extension of Palm Beaches. So all cases, what is happening, there's a huge market for automobiles, okay, 87, and optical fibers, and 9402, which is basically the medical devices, okay? So in my understanding, these will be India's next target, okay? So, so just try to understand whether in these products, what is our current stat, because all the simulation will go into the past data, and past data is showing there is not big export from India side. So the new result will also say that there is no future for that. But I'm not going in that direction. I'm looking at that these are the products which UAE is importing from the world. Maybe Australia is one of the biggest exporter of those products in UAE. So so we may be competing with Australia, Germany, China, Japan, Korea, which is also very important in those. Whether we are getting a better market access as compared to them, and how we are increasing our competitiveness in those countries. So iron and steel product, automobile components, optical fiber, and medical devices. Okay, so these few products in this basically some kind of a back of the envelope, I can say that these are the products where actually India is having a huge potentiality, even without doing this potentiality exercise. But what is the current situation? So you can look at This is the 2008. I am not taken 19 and 20 data to do this analysis for an obvious reason, because of pandemic-related disturbances. So if you look at in these cases, so one column is giving what is UAE's import from the world. The other column is giving what is UAE's import from India. So 7209, that's the flat roll products. Actually, the share is quite good. If you look at divide 21506 by 14031, it's a big number. Okay. Similarly, the bars, rods, stainless steel is 11676 and 3777. Okay. But if you look at the flat roll products of iron and non-steel of with less than 600 mm, so that means it's a fine product, you require certain skill, certain technology. Okay, so greater than and equal to 600 mm, we have a large share, but less than 600 mm, we don't have a much share. So why it should be? If you look at that means there must be some problems in our technology. So after signing the FTA, when you have come back home, now you need to sit on the drawing board and identify this product and try to find out that why they are not able to export. Okay, so once you look into this particular thing, then actually you'll be able to understand that how we'll achieve this $100 billion target. Look at the steel alloy and stainless steel ingots. 863 is their import. India is exporting only 3. 8713. Again, small. So some of the this may be the case where Indian companies are not doing very well, and it's mostly the multinationals we are looking at. Okay, and medical devices, actually India is now currently doing very well. A lot of companies have come up, and I'm hearing the appreciations all over about the medical devices industry, how they are going out, which definitely going to help our our citizens in terms of reduction in treatment cost, but we also need to get recognitions from the international world. So this is an area which is also part of Make in India and also under the Atmanirbhar Bharat strategy. So these are the sectors where actually we require some kind of a push. So just having an FTA and without having a push, we won't be able to reach anywhere. If I need to criticize the earlier FTA, exactly this was the problem. So FTA per se was not wrong. It was the push of the domestic industry which was not sufficient. It was not the ease of doing business which was sufficient, which would push the exports. That was not happening. So FTA is maybe you can say a significant a kind of a creating opportunity, but rest of the things need to be done by the exporters along with the help of the government. So if I give an analogy that you can make the stage, beautiful stage in an auditorium, which is the FTA, but if your artists are not skilled and if they're not trained, then the entire drama will be, or entire dance performance will be lackluster. So the stage has been made beautifully, a lot of advertisement, a lot of things. But if your artists are not trained, if they are not able to understand what to export, how to export, which products to export, how to diversify, this requires a different kind of a skill. So I think India needs that particular aspects. And after working more than 2 decades and talking to hundreds of exporters, I find this is India's biggest problem. Okay, and that's why even if you give them everything on the plate, the exporters are risk averse. Some of the large players will actually take the advantage. But any countries which, if you want to make that country an export-oriented country, it should be its SMEs. Their export should go up. So that's why our task is basically that after signing the FTA, we need to train these exporters. We need to make the information easily available. Just in a different context, I can give another example. I was working on India, UK, currently doing a project on that with some British universities. And there actually I was talking to some Indian businessmen in UK, and it was quite surprising. They said that, you know, if you look at China, we blame China all the time because that becomes a kind of an easy excuse. But if you look at, for a British importer, to identify a Chinese exporter is very easy. Okay, how? Even if you think of a company like Alibaba identifies the product-wise the SMEs with the full backup from the government, and they are being quality certified. That, you know, there is a process by which every SME is identified with 2-star, 3-star, 5-star, whatever it is. Okay, so any British importer go there and click it and identify, suppose in their HS code 10 exporters, they may be in different corners of China. Okay, whether the similar case can be done in India. So far, there are some half-hearted effort, which are at the private levels, but there are a lot of associations. I request Mr. Chatterjee also to think about this, because, you know, if all the associations can think of that, you know, we can actually put these SMEs and product-wise, their performance-wise, then actually any importer from UAE, or for that matter from Australia, if they want to import from India, they can easily identify. So that's very, very important thing. So you require another kind of a thing apart from your legal document, which will remain as a kind of a document. Whenever you have certain challenges, you take the help of this document and raise the issues in dispute settlement. But apart from that, in real-time performance, what is important is basically pushing these SMEs,
Correct.
helping them further. If you're not able to help them further, then what will happen? All these beautiful agreements will remain as agreements. Okay. What I have done, another kind of a technical thing, which is a complex mathematical formula called trade complementarity. Trade complementarity is basically try to understand that whether my export basket matches the import basket of my partner. If these two baskets match, then actually there is a possibility of a high growth. Okay, so so in the left hand side, we consider India as the exporter, in UAE as the importer, and the right hand side, UAE as the exporter, India as the importer. Remember, again, these exercises is done without having an effect of possible FTA. So if you look at on the left hand side, that India's complementarity index is between 0 and 100. 100 means very high complementarity, so you must you know, have a trade agreement with that, and 0 means you should not do it. Okay, so so if you look at on the left hand side, so you can see the numbers are increasing, right? So that means India has an advantage. Okay, India has an advantage now. If you have an FTA, so this advantage will go up. And if you train them, if you identify, if you push these exports, if you try to do a product diversification, do a lot of homework, okay, then definitely this number 68 can reach up to 90. Then what will happen? In Dubai, you will find out more Indian products than the Chinese products. Okay, so that's basically the next stage. So so that's basically important. On the other hand, if you look at currently what is happening, complementarity here is rising, but it is dwindling a little bit. So from 41, it has increased to 56. So that's also a big rise, except to 2019, because UAE's market itself is going down. If you look at now, their exports are also a bit of horizontal, not much of increasing. So India is having a better advantage prima facie. So this is the same diagram what we have seen. The ash color is about India and the blue one is about UAE. Another thing which we have done, which is basically one of my favorite exercise, most of the time we do it, whether there is a possible kind of an intra-industry. That means inputs going out and coming back. So some kind of a value chain if you're able to make. For example, we get polymer from UAE, but I'm exporting plastic products from it. For example, in case of oil, it is happening. I'm getting crude from there and exporting the refined one. So if the numbers are high, I mean between 0 and 1, then there is a possibility of a high intra-industry. And more intra-industry trade means more innovation possibility, because in two different countries, different culture, different ways of looking, and there's a possibility of product diversification where actually I was giving some report. So if you look at some of the numbers which I have put it in red color, those areas need to be looked into. For example, metal, we have seen that there's a lot of possibilities of metal export. We're also thinking of transportation product, then plastics and rubber and chemicals. Okay, so chemicals is also an important area where actually we can look into. I think the chemicals here also takes into account, perhaps I need to check it, the pharmaceutical, because the larger definition of chemicals also include pharma. So this might include the pharma also. Now coming back to the topic. So far I've just gave you the idea about the trade independent of any FTA. So from India's side, there are 11,908 products which were put on negotiation, and we found that immediate elimination, which is earlier we used to call it early harvest, 7,694. Phased one is 276, and there's an exclusion list of 1157. There's a thumb rule. Generally, 10%, close to 10% of the products which are put for negotiations, you can think of putting them in the exclusion list. Exclusion list means they still can be traded with an MFN, right? Like with India-ASEAN trade, what we have found out that most of the goods which were in the exclusion list, they were being traded more because India is having high demand. So the importers didn't care about the duty reduction, and they were importing with the MFN duty, but still it is profitable because MFN duty itself was also coming down. So why to blame on the FTA? Because in the exclusion list will also like an FTA, because exclusion list means they are under the MFN, okay, not under preferential. They're just like few years behind. That's it. So these are the excluded products, which is are okay kind of things, because for example, if you look at from the India's point of view, which is the table out there, India has put medical devices, dyes and pigments, and the tobacco products, tea, coffee, of course, and cereals, of course. These are the natural things. And for UAE, they put milk, tobacco, toilet tissues, and other products. Okay, so so now just to have 5 minutes, a quick understanding about what we can think of out of it. So India will benefit from preferential market access provided UAE on over 97% of tariff lines, but we're not sure whether there's a new kind of non-tariff barriers come up that we have seen in the past in many FTAs. While about 90% of India's exports to UAE will attract zero duty from the date of entry into force, about 9% of Indian exports will be subject to zero duty in a phased manner over a period ranging to 5 to 10 years. India has given the market access of to UAE around 100 subsectors. In case of Australia, you have seen it is more than 100. And while Indian service producer will get market access around 111 subsectors. Some of the subsectors are very important here, which is basically the construction related, engineering services, distribution services, educational services. I being in the education sector, I know it's a long-term issue between India and UAE. Dubai has a knowledge park. Many of the Indian universities and engineering colleges and MBA institute have gone to Dubai. So there is a big demand for Indian services. However, there are certain clauses which were actually making these services a bit difficult. I think Suel has mentioned about mutual recognition, and that's one of the important things. Second thing is movement of a natural person, and some service-related horizontal issues are also there. For example, setting up a company is out there, and those kind of things, and the banking systems also play an important role. So those issues are been addressed to a large extent. So let's see how actually these education services actually come up, whether there are a lot of Indian schools are able to go there, and whether financial services also there, but financial services, one of the most important challenges basically the Islamic banking systems, because they need to look into that aspects, looking at their softwares to address that particular aspect. Okay, let me just finish it. So this is basically the natural person supplying services, which is
Thank
mostly.
you.
Okay.
Okay, sir, please carry on.
Okay.
If you have anything.
Just few more slides I'm having. One of the most important thing is the digital trade, because with UAE, what we are expecting, there will be a lot of e-commerce.
Yes.
Okay, and that's why this is an important component in the digital trade. So here, the most important thing is that online consumer protections, because it's a foreign country. So there could be a misleading, deceptive informations which might affect the digital trade. Then online payment for the small trading companies, mostly for SMEs, and also to have an accepted legal framework in terms of the law for electronic commerce. And lastly is the personal data protection, which is definitely a globally a major debatable issue. And digital government are also important things, so that a lot of services, government services in both sides can be digitally accessed. Customs can be handled electronically from either country. Okay, so I think in case of the airport related customs issues can be done much easily, because with India Singapore free trade agreement services, Delhi airport and Mumbai airport and Singapore airport have made collaborations about fast it's a faster clearances of the goods based on certain standards of the cargo. So if the cargo is following certain standards, then there's not much of checking. So it's basically checking is done on a selective basis. And so there is a protocol. So these protocols are very important. I think, there will be a lot of trade between India and UAE, which will be, goods will be transported through airlines. So in that case, the digital trade and customs duty clearances will be very, very interesting thing. Government procurement, which is an interesting thing. But in case of India, as you know, there's a GFR rule, General Financial Rules, and that allows a preference to Indian companies, especially MSME. And this is a long debatable issue in WTO, because in that case, many countries actually offer preferences to their domestic companies, for example, and that might create a problem. Now the onus is on India. Let me give a reverse example. Like in Japan and Korea, after signing the FTA, and of course they have opened the IT services completely. And as you know, the government is the biggest buyer of IT services in any of the developed countries. Okay, but what is happening? Indian companies are not getting chance to directly participate in the bidding because of several conditions. Those conditions are not written in FTA. So these has come up as what we call quote unquote behind the border barriers. Okay. So what was happening as a result of that, Indian company needs to do a collaborations with the local Japanese or Korean companies to access the big market, which is the government. Okay, because there are certain preferences towards that. So now what is happening? Developed country will come back to India and say that you are also giving a lot of preferences to domestic MSME. But I think India so far has a very strong point, being a developing country, and it has given the preferences, and this is now clearly written that the MSMEs and local producers are having certain advantages in that. Rules of origin 40%. I think Suhail has discussed in great detail, so I do not need to go. It is more or less in the same directions, and it's a strict rules of origin, as mentioned. And Ministry of Economy of the UAE will look after that. Here, actually, the Ministry of Commerce will look after that, and with some exceptions, like aluminium and auto components would require value addition of 45%. Remember, there's a lot of possible import of aluminium products in the trade potentiality we have seen. So that's why we are having a larger rules of origin. Then there are some safeguards, just like Australia. We are also having a special chapter on pharmaceuticals. So you can understand. So India is now very much serious about increasing its exports of pharmaceutical products, and there is a worldwide demand of pharma products. I think there is one question on API during Suhail's part. I just would like to extend the answer what Suhail has given. What happened actually when we have found out that a lot of APIs are coming from China? Now there is a discussion, and looking back, we found that what happened actually, a lot of Indian pharma companies are having huge capability to produce API. It's just the cost of production is very low in China, so they have outsourced the API. And Indian companies actually started focusing more on marketing, and as well as some kind of external production systems in some other countries. So there's a discussion whether we can bring back that some of part of the APIs back in India, because we have the capacity to do it. We have not lost that capacity, but the only thing is that because the cost of production is much lower, so that's why we're doing it. I think the US has also done it. US has considered now pharmaceutical sector is one of the national importance area which needs to be protected. So it's the same kind of an idea is going out in other countries as well. So for example, it is it's a fast track within 90 days of the products meeting the specific criteria. And specifically and interestingly, some MOUs have been signed. Okay, one of the MOUs is basically APIDA and UAE's DP World about the food security corridor initiative. And then there is a Gift City and Abu Dhabi Global Market financial projects have also been signed. So these are the ways basically this entire thing is going on. And with a good expected excitement, I can just finish this lecture that most of these large industry organizations were very much excited because it's a known market. Okay, it's a known market. You just require to push the sector a bit, as I mentioned. You require skill, need to put the SMEs, Indian SMEs on the forefront, and it's not very far from India. It's just like from Delhi when I'm going to say Kerala, or from Delhi when I'm going to Dubai. I think it takes.
Thank you, friends, and thank you, Professor Nag, for his wonderful deliberations. Actually, Dubai, I stayed there for a long time, so I know that their total population is around 1 crore, about 9 million, and out of which 15% is basically locals. Means they are the citizens. That is around 15 lakhs people is the actual populations. Balance 85 or 80, 35% is contributed by India and others, Pakistan and others. So, as the professor said correctly, that we cannot expect a very big export potential in UAE, excepting in areas. But UAE can certainly take the benefit because we are a country of 135 crores people with huge populations, etc. So that is a very important thing. And one point he has very clearly said that what are the areas we should focus on, and he has really given complete details where we can enter, like in iron, steel, textile, pharma, etc., etc. So this is a very important thing, and thank you very much for all of you who are here for long. Yes, what is your question? Tell me.
Identified some areas.
Yes.
India can explore the opportunity of exporting. Here it is one item was mentioned ki the maritime vessels.
Maritime vehicles.
Vessels, the dredgers, floating cranes.
Yes.
There is an opportunity for
these
India
are very
to
good
exporting
opportunities.
the dredger and floating cranes, but at the same time he is mentioning the excluding the fishing vessels and the defense vessels. But in India, the manufacturer for the dredger and floating crane is not very.
Floating crane is there. Now you know JPC and others, they are manufacturing cranes in India itself. Caterpillar is also manufacturing in India itself.
For the floating crane, what are the capacities actually the UAE people they are required, and the dredgers? Since the local market for India, there is a very limited number of
players. That is what he has correctly said,
it can
that
become the opportunity.
Government has built up a good space to work, but the MSMEs and big industries are to take benefits of that.
Mostly if we look into the global market, the European countries, they are the
major
players
in this, because of technology is involved in that.
Yes.
Because high technology is involved and necessary.
Equipment, the main equipment is European. So how this can be a opportunity for
You need
India?
to have a technological gap, that is a separate area to discuss.
That is separate thing. Ki India we need to import the technology from Europe.
Absolutely.
But for the exporting, since the local market is not very much there, the builders, producers are not there.
I do not think so, because you cannot totally depend on the export product, export material or something like that. But that is a separate commercial decisions. First, what he said is very clear, that what are the areas we have a probability to enter. So that he has identified the areas. Now it is the company to find out whether they will enter or not. After all, I can tell you one thing, I am from industry totally, 45 years. This 5% benefit in UAE, what is the rate of tax? Rate of tax is only 5%, not like India. Okay, there is no CBD, there is no IGST, etc. So you cannot expect that because of 5% benefit, industry will prosper like anything. You have to be competitive. So therefore, your manufacturing cost has to be competitive. So tariff is one segment, but until and unless you are competitive in manufacturing the goods, even that 5% benefit is given to you, it is not sufficient to enter the market, because your scale of production is very important. If your scale of production is very limited, if your cost of production is very high because of electricity cost, compliance cost, financial cost, even this 5% benefit is not sufficient to you. So it is an additional benefit, but don't think FTA will allow India to immediately go and enter into the market and totally win. It is not possible. This is an additional, this is what I have understood. And I can tell you, any company to survive, they cannot depend on subsidies only. They cannot depend on government benefits. They have to have their own technology, they have to have their own cost competitiveness, and thereafter if they get some benefits like PLI schemes and all these things, this is an added advantage. You got my point? Yeah. So you have to find out all these areas, but as I said, MSME are to know. Because large industries like Larsen & Toubro, HUL, they are all aware what are absolutely they have made the entire screening and they know what is to be done. But the objective is to basically help the MSMEs. So MSMEs are also to know what are the areas they can enter, what are the areas are not positive to them, what are the areas we can expect that UAE to come to India, and there on those areas we have to take a protective action so that we can support our domestic market. These are all very important things, and this needs a huge education and huge analysis, and there I think IIFT can help a lot to the MSMEs in these areas. Sir, I am a student of IIFT, so I know how I have been trained in this area, alumni and others. Friends, thank you very much. Every good thing has its logical conclusions. So we are thankful to Mr. Nathani, Professor Nag, Mr. Mani, and Mr. Shah for their dedicated contributions to these workshops. Lot of people have joined through online systems, and we expect that your cooperations and help will continue to get, if not from Calcutta, at least from the Delhi, and sir in Delhi, and Mr. Nathani from Mumbai, and thank you very much. So we'll close today's workshops or on this foreign trade matter. Thank you very much.
Thank you. Thank you. Bye.